Hi, and thank you for joining us today for our virtual silver conference. Well, both gold and silver have been extremely volatile in recent weeks. Silver started the year at $70 an ounce, climbed up to $120 before suffering its largest daily drop since 1980, down a staggering 30%. And yet the fundamentals for silver have never looked better. Peak silver production plus recycling occurred in 2021 at 1 billion ounces annually, but demand keeps climbing and is now at 1.2 billion ounces annually, resulting in a deficit for the last 5 years. The single largest demand component of silver is for industrial uses at 60%, and this number continues to grow, followed by jewelry at 20% and physical investment at 16%. Given the recent drop in price, should we sell and move on, or is this pullback a buying opportunity? To help answer these questions, we've brought together industry experts along with a number of silver companies, beginning with John Ciampaglia and Maria Smirnova of Sprott Asset Management, Michael Oliver of Momentum Structural Analysis, John Miniotis of Abra Silver, Benoit LaSalle of Aya Gold and Silver, Shawn Khunkhun of Dolly Varden Silver, Walter Coles of Skeena Gold and Silver, Randy Smallwood of Wheaton Precious Metals, and we conclude with Mike DiRienzo of the Silver Institute. As a reminder, we're going to have an open chat on the right-hand side of your screen, so stop by, say hello, make a comment, or you can ask a question. We're also going to be running polls throughout the conference to get your views on gold and silver. I want to thank our corporate sponsor, Sprott Inc., a global leader in precious metals. I hope you enjoy the conference. John, thank you very much for joining us today. You are on the front lines of what's happening in precious metals, and we've seen a great deal of volatility here in recent weeks, both on the way up and the way down. And I want to talk about both directions. And I first want to get your thoughts on what happened on the upside. And one of the things that I noticed in late 2025 was that the U.S. Geological Survey added silver to the critical minerals list. How important do you think this was in the price of silver going significantly higher?
Yeah, I mean, it's been an incredible wild ride for silver over the last 6 months or so. And I think it's important to maybe take a step back because, we've been waiting at Sprott for a long time for this silver catch-up trade to play out. And it finally did play out. And we felt as though silver was a coiled spring. Because if you think back to its old market high of in 2011 of around $50 an ounce, it basically went from early 2011, $50 took all the way to November of 2025 for it to retest that high. So a very long period of time had gone by. And it really lagged a lot of other commodities. And we didn't really understand why, because there's been a supply deficit for a number of years. And as you mentioned, silver is a strategic metal for a number of reasons. And this catch-up trade has obviously played out. But in the last 5-6 weeks, we saw a real acceleration of it. Some of it, we saw some warning signs of kind of speculative fever. We saw a silver futures-based ETF in China at one point trading 60% over its net asset value. And the ETF sponsor, the ETF sponsor basically warning investors about the danger of buying a fund 60% over its implied value. So there was clearly some signs of, I think, very speculative late stage, buying, which is obviously dissipated in the last few weeks as the price is kind of moderated back into the mid 80s, which is still incredible given we hit 50 in November.
And maybe you can also speak to the Sprott Physical Silver Trust and what sort of flows you've been seeing into this product.
Yeah, I mean, we have, I think, the second largest physical silver fund in the world. We're very proud of the vehicle. We've been running this vehicle since 2010, and it's a closed-end fund domiciled in Canada, and it's listed in the Canadian and U.S. exchanges. We've actually had positive flows year to date, in contrast to our larger competitor, which has had outflows. So, and the reason for that is pretty simple. We tend to attract a different kind of investor. We tend to hold people that are holding silver as a long-term buy and hold, a strategic investor, whereas we find other investors are more day trading, playing the options market, and are taking very short-term tactical bets on the price direction of silver. So very different demographic. And our trust is 100% fully allocated silver, segregated, stored outside of the traditional, bullion vaulting system. All of our metal is stored at the Royal Canadian Mint, as well as one of their sub-custodians, which is Brinks. And we own an enormous amount of silver. Since 2020, I think we've purchased over 150 million ounces of silver, which is an incredible amount. And remember, this is silver that we just don't take off of somebody's pile and change the ownership title. We actually buy the silver, physically ship it to our vaults, and put it in long-term storage. So we have been directly involved with all of the procurement of that silver, and it's 100% there and audited by our team as well as our outside auditors on a regular basis.
And you mentioned it's fully allocated. What exactly do you mean by that?
That means that the trust owns title, carries title to all of those ounces, that there is no unallocated metal, which is basically metal that could have multiple claims against that ownership pile. So these are 1,000 ounce London Good Delivery bars. And I can tell you, I've been in our vaults, and it is absolutely a thing of beauty to walk through and see this just enormous amounts of pallets stacked with these bars. And it's obviously a very convenient way for investors to own a very, bulky metal. If you think about one of these 1,000 ounce bars, they're about 68 pounds. So it's people don't even pick them up. They have machines that pick these bars up and pallet them and stack them and whatnot. So it's a convenient way for investors to own the fully allocated silver, not have to pay very high premiums on coins. We see that when there is high demand in silver, there are shortages of coins, and dealers often charge very high premiums to reflect that scarcity. And with the Sprott Physical Silver Trust, you're basically buying around the spot price of silver, or in some cases, you could actually be buying below silver, which means you're buying below the spot price. So it's been a very popular product over the last 15 years, and I think that's why we've grown it to $17 billion.
And what sort of flows have you seen in the last few weeks? Have you seen a lot of, I would imagine, like in late 2025, early 26, you saw a lot of flows into it, but have you seen a lot of money come out of that product?
Yeah, the last couple of weeks has been really quiet in terms of flows, but the trading obviously has been very excessive. We've seen some pretty wide swings intraday in the price of silver, and the trust is not immune to that. We did see a few days where the trust traded at a very wide discount relative to historical norms, which I think reflects some uncertainty in the market and some, searching for direction between bulls and bears. They're clearly fighting it out right now, and so far we've built a little bit of a base, and I think we're moving back up, which is good. But it's been pretty quiet, although the trading has been pretty volatile, more volatile than I can remember.
And in addition to the U.S. Geological Survey adding silver to the critical minerals list, the U.S. government recently announced that they're also going to start a $12 billion reserve fund for critical minerals. What are your thoughts on this, and what will this do to the silver price, if anything?
Yeah, I mean, silver and a whole bunch of other metals have recently been added to the U.S. Geological Survey list of critical materials, and I think it's kind of a catch-up. I think for a long time, people took it for granted that these metals were readily available. The issue is, a lot of the silver is mined in other parts of the world and is processed in other parts of the world. And recently, China has put export restrictions on silver, which is, I think, really caught people's, attention that, silver is not going to be flowing as easily as it did to other countries from China. So we will see this vault project, as they're calling it, is really designed to, I think, kind of stand up or help stand up the U.S. mining sector by addressing reform and reforming permitting timelines and costs for companies. They're talking about protecting their industry, and that also could include price floors. They're talking about public-private partnerships in both equity and debt financing that the government could make, in some cases in exchange for offtake, which means future production. So there's a lot of things going on, and they're also trying to protect the industry from what they view as unfair trade practices by China, which heavily subsidizes industries and has been known for suppressing prices or dumping a lot of production in other countries. and really undermining local efforts to bring production to market. It's not just the mining of these minerals that I think is top of mind. It's also the processing, refining and processing, because again, China, depending on the mineral, somewhere between 50 to 80% of some metals are exclusively refined and processed in China. So the whole supply chain needs to be reoriented back to the West. And I think that's why you're seeing these big policy announcements between the US government as well as a lot of mining companies and end users of these materials who seem to want to support this initiative.
And 60% of all silver production is used for industrial purposes. And it's a very important metal for the production of solar panels. And China is the largest producer of solar panels. And you mentioned that China has put export limits on silver. But I'm kind of wondering what your thoughts are on China in terms of driving the price up and also taking the price down. We've seen them do this with other metals in the past. They did it with uranium back in 2010, 2011. More recently, they did it with lithium in the early 2020s. They drove the price up to $80,000 a ton, and then it collapsed all the way down to $9,000. But maybe you can just speak to that and how that relates to silver.
Yeah, I mean, there's no denying, the Chinese entities are very large players in all metal markets. And there's a lot of chatter in the media right now about a particular trading house in China that has taken a huge naked short position against silver in the last week or so. And it seems to be valid because the reports are indicating the Chinese government has actually intervened to basically wrangle in this entity. We've seen this happen before in 2022, where a Chinese nickel producer had massive short positions in nickel that ultimately broke the London Metal Exchange and resulted in massive lawsuits. And so, these kinds of market dislocations are rare, but they can happen. It does feel like we've gone from this kind of speculative FOMO the last couple of weeks to now people, have flipped their bets and trying to push the price down. So, and this is why I think the trading has been so volatile, because we got a real tug of war here going between bulls and bears. Now, putting all that aside, longer term, silver is a very important metal. It is in a supply deficit for the last 5 years and expected to be this year again. And so the longer term fundamentals, I think, support higher pricing. And, if you think about where we are today in the mid 80s per ounce versus 50 in 2011, still seems very attractively priced to us. This catch-up trade took a long time, but it's clearly, I think, in motion. And while it's going to be volatile and bumpy along the way, we still are quite constructive on the price of silver.
I want to have a deeper conversation on something you just mentioned. You mentioned FOMO and also speculation, and all in one sentence. And I recently read an article in the Financial Times, and they were talking about the retail speculative component of what's happened in the silver price on the way up. And in fact, they said they did a survey, and the number of silver mentions on various social media platforms, including Reddit, increased 20 times versus the 5-year average. They mentioned a very heavy activity in some forums on Reddit, one called Wall Street Bets. It has 15 to 20 million subscribers. Another one called Silver Bugs. It has over 200,000 subscribers. But I kind of wonder, has silver become a meme stock? And maybe that explains some of the activity we've seen here in the last few weeks.
Yeah, look, I mean, silver investors are a super passionate group. I think they're just getting excited because the market signals are very strong, and they've been waiting for these market signals for a long time, given how long silver underperformed. I think where you're seeing a lot of this speculative play come in is really these CTA funds, these commodity trading advisors and hedge funds that have incredible amounts of capital and access to leverage. We see them really piling in on trades at times, mostly through derivative forms, whether it's futures or options. To me, those are the ones that have really outsized impact on metal markets in the very short term. Some of that, I think, is starting to wash out. And that's obviously not healthy because they can distort a market in the very short term. But I think retail investors are just excited because a metal that they have viewed as undervalued for a very long time is being re-rated. It's obviously being pulled higher by the price of gold because there's obviously a very deep relationship between the two. but now you also have the added, industrial use case and geopolitics that I think are making silver a more strategic investment and a metal of interest across a number of superpowers. And that is obviously giving, I think, a further kind of bid to the silver thesis.
And John, maybe you can just communicate to investors who are watching this action in both gold and silver, how should they respond? Because when you see a stock go up, or when you see an asset go up 70% and then collapse 30% in one day, there's going to be a lot of, fear associated with that. What would be your messaging to investors who are watching this and they haven't made an investment yet?
Yeah, I mean, it's a great question, and obviously these kinds of daily moves are not the norm. They're really off the charts in terms of how unusual they are. And I think as a result, you have to be very careful you don't get whipsawed around by, trying to chase the market and then selling at a low and then see it bounce back very quickly. Our advice to people is always build a position slowly over time as you accumulate wealth, add dollar cost average. It's very hard to react to these very fast moving speculative moves. So you have to think long term, and you have to make sure your position weighting is appropriate for you, because we are in a period of obviously very high volatility. But I think people need to focus on the fundamentals and kind of ride it out here, because it will settle down. It always does, and we'll get back to more fundamentally driven markets versus speculative and highly levered kind of performance chasing.
And you spoke about the Sprott Physical Silver Trust. Maybe you can mention a couple of other products investors can examine if they want to take a position in silver.
Yeah, I mean, we have a couple of other options. We have the Sprott Physical Gold and Silver Trust, which is kind of a mixture of both metals. That's popular for people that just want to have one position with two metals. Our Sprott Silver Miners and Physical Silver ETF has been very popular with investors over the last 12 months. And that is giving you exposure to a basket of silver miners, producers, developers, explorers, as well as a small allocation to physical silver through the Sprott Physical Silver Trust. So that is going to behave differently. Some of the miners haven't, moved as much as the physical market itself. And these mining companies right now are super well positioned to generate profits, given the high silver price, as well as to raise capital, which is really important if you're trying to move a project along to construction and ultimately production. And the silver miners have been huge beneficiaries over the last year of this move in the commodity price. So that's been a very popular choice with our investors. So those are the three options that we have right now at Sprott.
And John, as we wrap up, you and your team have created a lot of research for investors to consume so they can read up on precious metals, including gold, silver, and other metals. If they want to do so, where can they go?
Yeah, please visit our website at sprott.com. Visit our Insights tab, and there you will be able to read our precious metals commentaries. We have some really great podcasts with internal experts as well as external guests. And please visit the product pages for PSLV, SLVR, and CEF. Those are the ticker symbols. Please review those documents and make sure you understand what you're investing in, because even though a fund might have the name silver in it and another fund might have name silver in it, they can be very different offerings. So we encourage people to look under the hood and make sure they understand what they're investing in.
John, great insights. Once again, thank you.
Thanks for having me.
Hi, I hope you're enjoying the conference. Did you know that 80% of our viewers are not subscribers to our channel, Bloor Street Capital? So please hit the subscribe button and also hit that thumbs up button. Thank you for your support. John, thank you very much for joining us today. Abra Silver's primary project is the DiRienzo Silver Gold Project in Argentina. And when in operation, it will be one of the largest primary silver producers in the world. And a lot of progress has been made at DiRienzo in the past year. And this has been reflected in the stock price, which is up over 300% in the past year. But why don't we just start with the highlights that have been made in the past year and which have resulted in this massive outperformance?
Yeah, look, sounds great. I think 2025 for us was clearly excellent year. I think the market's clearly starting to recognize now that Diablilos is truly emerging as a tier one primary silver asset. Obviously that's reflected by the share price performance. And as you mentioned, of course, we had an excellent rate of return last year on the share price. Of course, that benefits from the strong rising silver price environment for sure. But also clearly, I think reflects, the our team sort of and how we've continued to consistently deliver along parallel tracks here towards moving this project forward. And so I think, one of the clear things on the exploration side, we've continued to have incredible success. Last year, sort of mid-year, we updated our resource estimate. Once again, we added about 100 million ounces of silver equivalent resources in the measured and indicated category. And that's just with one year's worth of drilling. And so our exploration team here has really just delivered consistently. We continue to have one of the lowest discovery costs in the industry. And so, I think just continuing to grow the resource here, we obviously have a very impressive scale already with about 350 million ounces of silver equivalent, and that continues to grow. So we'll be announcing yet another resource estimate along with our feasibility study next quarter. So this project keeps getting bigger and bigger and bigger. But beyond just the drilling, I think 2015 was definitely a very, very important year for us because, again, the re-rating in our share price clearly shows that we are beginning now to transition from just a pure explorer into now a developer. And so, I think there's, we have a high quality primary silver project here, very, very scarce in today's environment. And now where we stand, I think we're standing on the doorstep of a construction decision later this year. And so the market's clearly starting to recognize that. And, I think very, very exciting time for us, obviously, as we look ahead here.
Well, an additional 100 million ounces goes a long way in this environment. But one of the big drivers this year for Abra Silver will be the inclusion into an incentive program called RIGI. And the purpose of the program is to incentivize investment in the country of Argentina. Can you just outline what RIGI is and what this means for Abra Silver?
Yeah, that's certainly been a game changer for us as well. Argentina now has a new policy. As you mentioned, RIGI is the incentive regime for large investments. And without question, this has been a total game changer for Argentina as a whole, and especially for mining, which is obviously a very, very capital intensive industry. And so, look, essentially, this is a federal law now designed to attract major capital. And what it does is provides now a new framework, 30 years of legal and fiscal stability. And so for Abra and our project, I think it's crucial having RIGI in place here. What it does on the tax front, it drops your tax rates from 35% down to 25%. It eliminates export duties, import duties. And so right now, going forward, we'd have zero duties on importing all equipment into Argentina. And then importantly, no export duties on exporting gold and silver once you're in production. And so those are, incredible benefits, billions of dollars in additional free cash flow at anywhere near current spot prices. And then on top of that, they've also now, for projects that qualify for RIGI, removed all foreign exchange restrictions. And as you know, I think that's historically been a major hurdle for investing in Argentina. Now that's going to be removed here for our project very shortly once we get RIGI approval, which is essentially next month. So before the end of this current quarter. So very, very positive changes in Argentina. And I think, looking forward, Argentina now, again, is going to be one of the most strong, sort of competitive fiscal countries, not only in South America, but anywhere globally with a 25% tax rate, no export duties, no import duties, no foreign exchange restrictions, really, really opening the door for projects moving forward. You've seen a number of projects, tens of billions of dollars of new projects have been approved already under RIGI. We believe we're going to be the next one to receive approval. And that should be very, very shortly here.
And once you do receive approval, what are the next steps?
So yeah, so for us, there's a number of milestones coming up. So RIGI approval is obviously key. And then getting your permits. So the environmental impact assessment, we submitted those to the provincial authorities about a year ago. Again, we're in the final stages of expecting to receive those environmental permits. So we expect to receive those hopefully before the end of this quarter. And then the final stage for us is delivering a feasibility study, a definitive feasibility study. That's on track. Again, the team's focused on that and finalizing that for next quarter in Q2. And then once you have all of those in place, you're ready for sort of project financing discussions and then making a construction decision before the end of this year.
So let's discuss a lot of the issues you just outlined in more detail. Pre-feasibility study was released in December of 2024, and I know a lot has changed since then, but why don't you just take us through the highlights of that study?
Yeah, so our pre-fees, I think, look, it's kind of a proof of concept for the scale, the size, the quality of our project. Yeah, as you mentioned, a lot's changed since then. Importantly, commodity price assumptions. I think what we used in that study are laughably conservative at this stage, given where we're at in the market. I think the base case price assumption was just over $25 silver and $2,000 gold. And so, yeah, you can look at those figures. I think the important takeaway is even at those ridiculously low commodity prices, the project has very, very robust economics. It had, a quick 2-year payback, a robust net present value after tax of about 30%. But more importantly, obviously, if you look at it under today's lens, today's commodity price or consensus commodity prices are still very conservative. I think it's about $40 silver, $3,300 gold or so. But yeah, the numbers, if you adjust the pre-fees with those prices, really become, I'd say, staggering. I think we've, after tax rate of return over 50%, payback of under 1 year. And so in the mining industry, as you know, I think, finding that kind of profitability for a project of this size and scale is incredibly rare. So right now, the focus is on, finalizing our DFS, as I mentioned. That's going to be ready next quarter. And that study is essentially going to be the final blueprint then that we could take to banks, take to strategic partners to secure project financing. And then that's, ultimately sort of the final technical deliverable here. And then once that's published, I mean, very exciting. We'll be looking to transition from studying this project to actually building it. So yeah, very, very exciting times for us for sure here.
And John, do you expect much in the way of differences between the pre-fees and the definitive feasibility study?
There will be a few for sure. So we are looking to essentially optimize the pre-feasibility study. So a number of the parameters are being held the same, and that again goes in hand with the permits. So the EIA permits that we applied for were based on the pre-fees. And so now we don't want to start making major changes. We obviously can't change the throughput rate or the scale of the operation at this stage. So those will be held the same, but this new study is going to be based on a much larger resource and reserve. So you're going to have obviously a much larger mine life here. We're seeing this essentially as the phase 1 of Diablilos. Clearly, at some stage, it's going to make sense to further expand the throughput rate. So we're focused on getting these permits in place, announcing this feasibility study, declaring a construction decision, and starting to build essentially phase 1 of Diablilos. But then the focus will shift on future expansion opportunities, and there are plenty here as well with additional exploration upside. And so, yeah, it's going to be based on a much larger resource, based on a much larger reserve. We're also at optimizing sort of the power situation. We were previously assuming we would build a 20 megawatt solar plant with diesel generators running as backup. Now it's looking, I'd say, highly likely that we're going to have access to grid power connection. One of our largest shareholders is a company called Central Puerto. They're the largest utility company in all of Argentina, and they're studying grid power connection through this region. So that's obviously going to be substantial in terms of the potential savings there, not only in capital costs, but obviously in operating costs. And then a few other sort of optimization opportunities that will, again, help refine what we had in the prior study.
And you mentioned the throughput's going to remain the same at 9,000 tons a day?
Yes, that's correct. For this study, it will. And again, I think we'll look to revise that down the road.
And you also said there's going to be an increase in mine life. What will it extend to?
Yeah, well, based on the resource, I mean, the resource has grown already and continues to grow. And so when we based our pre-feasibility study, the resource at that time was about 250 million ounces on a silver equivalent basis. Then we announced the pre-fees based on that. In mid-year, as I mentioned, in July of 2025, after the pre-fees was released, we had already grown the resource to 350 million ounces. So about like a 35% increase already in the size of the resource. And then subsequent to that, we completed phase 5 drilling. And so we're now, that was completed at the end of last year. And so we're now finalizing the resource, including phase 5. And then we're going to put together a mine plan based on that larger reserve and announce that as part of the DFS. So it's going to be significantly larger. Obviously, it's grown since the last update. Obviously, we can't quantify exactly until we've run the figures, but a very, very significant increase from the pre-feasibility study, which was based on 250 million ounces on a resource basis. And, clearly it's grown significantly since then.
And John, much of the ore for the early years will come from the Jack deposit, and this is very high grade, very shallow,
That's right.
and this is really going to help with the economics. Maybe you can just touch on that.
Yeah, so the ore body here is now continuous. You have the main occulto zone. Importantly, this is all near surface and it's open pittable, easy to mine, easy to process, near surface. It's all in oxides, gold and silver, of course. So occulto is the main deposit, and we've been consistently growing that over the past 6 years or so now. But Jack was a more recent discovery. It's essentially the southwest extension of occulto. And that's predominantly silver, whereas occulto is essentially 50-50 life of mine, the revenue breakdown between silver and gold, depending where you're at in the ore body. Closer to surface, it's silver, and then you get a high-grade gold zone beneath that. Jack is just close to surface, and it's entirely silver, really. And so Jack's grown significantly. Again, when we announced the pre-fees, I think the resource at Jack was about 5 million tons. In the latest resource estimate we announced mid-year last year, it had grown to 13 million tons, so almost triple the size, and it's obviously grown even more. So now we're going to incorporate all of the most recent drilling at Jack into the DFS. So Jack really plays, as you mentioned, in the near term, over the first 6 to 8 years of the mine plan, you're going to see very, very significant silver production. And it's largely driven by the higher grade silver-rich zone at Jack.
And John, I'm sorry, maybe you mentioned this, but what's the CapEx?
Capital cost was $540 million in the pre-feasibility study. We have seen some, inflationary pressures consistent with everywhere globally. So we'll be updating that CapEx. But again, we've been tracking it very, very closely. We don't expect any major surprises here. But yeah, roughly $540 million will be the initial CapEx here.
So why don't we talk about your balance sheet and also your funding plans? How will you fund construction?
Yeah, so right now, very, very strong balance sheet in place. So about $60 million as of the end of last year, Canadian. So it puts us in a very strong position this year to obviously finalize the feasibility study, finalize the additional drilling we're doing, and then do some early works construction activities as well. Looking to potentially expand the camp at site, start ordering some long lead time items. So we're going to put that money to very, very good use and start moving the project forward so that there are no delays. But certainly there'll be a project sort of financing needed here to raise the $540 plus million US. And so we will be at the right time looking at all the alternatives out there. Potential debt financing, there's potential convertible securities, there's potential to, do a stream here, either on the gold or silver. if we wanted. So we have lots of options at our disposal. Right now, the focus is on let's get riggy, let's get the permits, let's finalize the DFS. And then we've given ourselves until sort of, second half of this year to evaluate the project financing options in a lot more detail and make the right decision there on how to, make sure we raise the money here in a very, very efficient manner that, captures, keeps the upside for our shareholders, our existing shareholders.
So let's talk about your drilling results. And you mentioned earlier that you're starting a phase 6 drilling program now. Is that correct?
Yeah, we already started phase 6, so that was in January of this year. We kicked off our phase 6 campaign, another 15,000 meters, highly strategic drilling here. I think the focus for that's really twofold. I mean, first and foremost, we're always continuing to expand the margins, growing the existing resource further. So it really is all step out drilling. Very, very little infill drilling is planned for phase 6. It's continuing to grow both the Oculto deposit and the Jack deposit that we just talked about. And so phase 6, I think we're really focused on growing both those zones, particularly focused at this stage on the northeast zone, continue to grow the high grade Oculto deposit. We're seeing some very, very good gold intercepts there as of late. So lots more drilling to do there. And then I'd say the second sort of priority for us is we do still have a number of earlier stage sort of targets all across our land package. And so certainly we're going to be evaluating those, drilling those as well later this year as part of this campaign. So lots of drilling news here to kick off once we start getting back those initial assay results from the phase 6 program. And yeah, I think obviously the exploration team over the last 6 years and their track record speaks for itself. And yeah, looking forward, I see no reason why we would expect this year would be any different. I think it's going to be another very, very exciting drill campaign for us, focused on finding more ounces here on a very, very cost-effective basis.
Hey, John, how many rigs do you currently have on site?
We have 3 rigs, 3 drill rigs, and that's similar to the phase 5.
And John, if everything goes according to plan, when will Abra Silver be up and running and producing silver?
Yeah, so again, very near term here. So looking to make a construction decision before the end of 2026. And it's going to be a 2.5-year sort of construction timeline from that date. And so initial production will be in 2029, so before the end of this decade, which, yeah, is still years away, but in mining terms is light speed. As you know, it takes, sometimes decades to move these things into production. And for us, a couple years is right around the corner.
And John, as we wrap up, you've already provided a lot of detail on what you and your team will be working on in the coming year, but maybe you can just summarize for investors what they can expect in terms of news flow here in the first half of the year.
Yeah. So again, I think a number of catalysts here for Abra Silver in the very near term. And so, yeah, I think this coming year for us is really all about execution. I think our investors are looking forward to 3 major upcoming catalysts here over the coming weeks and months ahead. As we talked about the RIGI approval, we're expecting that imminently. The EIA permits, getting your permits in place, of course, is a major milestone for any explorer. And then finally, announcing our final definitive feasibility study, which we'll need, obviously, before making a construction decision later this year. And so I think, yeah, very, very exciting for us. I think, over the last several years, we've been very, very busy de-risking this asset. And now as we look forward, I think, very, very uniquely positioned as, as an explorer transitioning into a developer, and ultimately into a producer, in a couple of years' time.
Well, John, that's been a great update. And once again, I want to thank you for spending time with us today and congratulations on the progress.
Pleasure. Thanks very much.
Hi, it's Jimmy, and I hope all is well with you. Before we get on with the interview, one small request. Please follow me on Spotify and Apple Podcast. Leave a rating, leave a comment. And if you have any suggestions on who you would like to see interviewed on the channel, let us know in the comment section. Thank you for your support. Now let's get on with that interview. Benoit, thank you very much for spending time with us today. 2025 was a pivotal year for Aya Gold and Silver. You and your team executed on a number of milestones, and this resulted in record production of 5 million silver equivalent ounces. And most of this production came from your primary asset, and that's the Zgounder. And it's both an open pit and underground mine. You've announced a number of optimization studies which will result in even higher production in 2026. Can you just take us through these optimization programs that you've planned?
Yes, absolutely. Thank you for inviting me again. It's always a pleasure to talk about Aya. And you're absolutely right. 2025 was a pivotal year. We completed the ramp up of our new plant. So we had two historical plants. We brought into production a third brand new plant, and we did all the fine tuning and the nameplate capacity of the complex is 2,700 ton a day, and now we're running at 3,700 ton a day. So we're already like almost 30% above nameplate capacity. So you're right, your numbers are right. Last year at Zgounder, we produced 4.8 million, and this year at Zgounder will produce 5.8 million ounces. So, all the KPIs that you need to manage in a ramp up, plant availability is impeccable at 96%. Plant recovery is 92%, 90%. Again, very, very good. Plant throughput is 3,700, and mine throughput is about 4,500. So we're stockpiling right now, which is rare. Like we're at the beginning and we're even stockpiling, or as the mine throughput exceeds the plant throughput, and we're very happy. And the last thing we needed to manage correctly was the dilution of the grade. But also because of the higher silver price, you mine a little bit differently. Is when you hit a pocket of 100-gram material, you just don't leave it there. You take it out. So the grade is affected by your mining method. So you do your reserve and your resource at $28 silver, but when you mine and the mine captain calls you and he says, "Hey, I just hit 60 meter of 100 gram," I leave it there, and I backfill, or I take it out. And the guy who runs planning says, "Well, if you take it out, you're going to reduce my average grade." And okay, but if you leave it there, we're going to lose it for life. Take it out. So of course, when you mine at 70, 80, $90 silver, it's mining is a dynamic system. If you have areas that are new to the block model that come at you while you have opened a stope. So, and Zgounder is like that. Zgounder is not a silver vein. It's not like you mine the silver vein and that's all you have. It's a piece, it's a loaf of bread. It's like 200-meter wide. It's 700-meter deep. It's a 1.4 kilometer. And once you're out of the structures that are 200-300 gram, you get into hollows of 180. And we took it all this year, and we continue to do that. We're taking it all out because it's profitable. Our all-in cost will be on life of mine at Zgounder. The all-in cost will be like $19. Well, if the selling price is 90 for simplicity, less 19 or less 20. You have a $70 margin. So you have to take it out. So that's what we've done at Zgounder. Currently, we're at cruising speed. It's running very, very well, fully staffed. All the water is there for the year, electricity, and we're executing. At Q1 is looking very, very good. And we're executing. So that thing is done. It was built below budget and approximately on time, and now it's running very well.
And you've also announced CapEx of $36 million for 2026. What's that going to be allocated toward?
It's two things. It's the ramp. We're bringing the ramp all the way down to the bottom. So the ramp is 2/3 down, and we're taking it all the way down because we want to go to the floor of what we see to be the deposit, which is a granite structure. We want to go all the way there because it really looks like on that floor there's between 1 and 3 meters of very, very high grade silver. And there's also half of that is also for plant expansion is we're running at 3,700 and we're looking to probably take it to 4,000, 4,200. So little, more power here, another little cone crusher, just little things to make it even a more robust. Because if you do mine these 100-gram potatoes or pockets, well, you want to increase the tonnage a little bit of the plant so that you can process it and not just stockpile it. Because right now we have been stockpiling a lot of lower grade material that is not even accounted for, that is expensed, but that we have on site. So we'd like to, just increase capacity a little bit, put some of that through, and look, just produce it while it's there and while the selling price is good.
And Benoit, when you say lower grade, can you quantify that?
So what we stockpile on lower grade material is anything between 40 and 80. So that's like something we don't touch right now. We just put it there. And then we have our regular ore, which is between, I would say, 100 and 160, which we have, our stockpile. And then we have run of the plant or run of the mill, so which currently runs between 150 and 160. So it's really grade management, but the lower grade material for now is being taken out. We keep it and we will with the additional capacity, and we're doing a few analysis on it, see how we're going to be treating it. But it's there, and there's like 500,000 ton of that material, which has gone through the P&L and is sitting at site.
So why don't we talk about the exploration program at Zgounder now? You have 20,000 meters planned for near mine and 10,000 meters planned for regional exploration. Can you just speak to these two programs?
Yes, so at Zgounder, the main loaf of bread, which we know very well, we believe repeats itself. It's just not a one-off thing. We believe it repeats itself. So we've done a lot of work, a lot of geophysics. We've used AI. We've treated all of our data through an AI system, and we have about 14 targets close to the mine that have the same signature. Sometimes they're a bit deeper, they're at surface. So we're going to be doing 20,000 meters of the current deposit extension and nearby extension in other geological trap. Because what it is there's been a lot of fluid in that part of Morocco. This is why we have that beautiful first structure, but there are others. We know there are others. We just need to find another structure. So that's why the 20,000 goes for near mine. And then there's 10,000 for the greater district that we have, where we have a team that, just walks the ground, look at the structures. We also use AI, we use technology, and there are areas that we want to go and test. I mean, we have anomalies, we have things that we like, but it's not like as much a target as what we have through AI. So we'll be doing about 10,000 meters there.
And the other big news in 2025 at Zgounder was the release of an updated technical report. What were the findings?
So yes, we took 2 years of drilling, actually even 3 years of drilling, 2022, 3, 4, and 5, and we put that into the block model. We've looked at the new capacity. We also had the plant because it was built. And we've done a new resource model based on our understanding of the geology. And today what you have is an 11-year mine life, which is based on 2% of our property, 11-year mine life with 6 million ounces of production per year on average. This year it will be 5.8, next year 6.2, it goes to 6.4, but it's pretty flat with an AISC of with a cash cost of $16.25 and an AISC of about $19. So this is like set in stone. This is the next 11 years. The mine plan's built. We're doing the development, as we mentioned, to go all the way down to the granite. So we have the bottom of the deposit covered. We will take 70% through the open pit, and that's being done as we speak. So we have now really frozen in time this deposit, the operation, the profitability. Of course, we don't know the selling price, but we know the cost. And now that's why we're doing exploration near mine and regional, because we would like to find another structure like that and hopefully increase production from 6 to 8 to 10 million ounces. We have the capacity, we have the space, we have everything to do that. We just need another mine. The first mine, the Zgounder main mine, is at capacity at 4,500 ton a day. It just cannot produce more than this.
So let's move on now and discuss your second asset, and that's Boumadine. And one of the interesting aspects of Boumadine is the production is coming from a stockpile of historical material that's very rich in both gold and silver. Can you speak to that?
Yes, so Boumadine has been in production for 500 years, stop and go, and there was this two mountains of residues that were there, and we knew at one point we would have to move those because it was right over the open pit. I mean, because historically they just followed the vein with little galleries, and we had 240,000 ton of material. And with the silver price going up and the gold price going up, at one point somebody in the office said, "Hey, we should do a couple of drill holes into this and treat this like as a deposit and see." And so we started doing some drilling to realize that, as you say, it's like 180-gram silver, 2-gram gold, and a little bit of other things. And when we spoke to our off taker and we said, "Look, we could have that, and we can put this in bags or containers, ship that." He said, "Sure, I'll take this immediately." And we are. So we are, shipping this 10,000 ton every month for 2 years, for 24 months. And we're making between 3 and 4 million US dollar a month of profit. And it's also debugging the route to the smelters where we're going to be sending the main concentrate when we get into production. So we've debugged the port and the logistics and the transport and the payment. So we're using the same broker, and it's working very well. So we started shipping in November, and we've done 2 months, and that's what added to our production profile, 178,000 ounces of silver equivalent, because there's a little bit of gold. And this year, we will be between 1 million and 1.2 million ounces of silver coming out of the stockpile at an AISC of $11.
Those are pretty good margins.
Look, it's for something you have to move anyway, because it's over the open pit. So because the structure is underneath this, so it's quite nice. It also confirms our mining license. It confirms the way the export permission, which we all have. So it was a very nice, really lunch conversation one day in our kitchen here in Canada, where the team meets every day for a quick lunch, and it came out of that a discussion like this. So very profitable lunch.
And I'm surprised when you said it's been in production for 500 years.
Well, Zgounder has been in production for 2,000 years. So those mines were discovered, Zgounder, by the Romans, and 2,000 years ago. And 1,000 years ago, we know that the silver from Zgounder was being used for the coins in Morocco. That was the currency. And then it stopped and it closed and it reopened, and they were just mining the top of the structure. They didn't go very deep, but it was so rich. They were mining the 2, 3, 4,000 gram per ton veins, which we still have, but we're mining the whole package, not just the veins. And Boumadine, well, Boumadine is the father of all deposits. That's what it means. Bou, and it's a little bit when you go to UAE and you say Abu Dhabi. Abu is the father of. So it's called Abu Dhabi. So here it's Boumadine, and it's the father of all deposits. And it is. It's just, you will see there'll be a resource update in June. We're going to add quite a bit of resource to the current 450 million ounces of silver equivalent. And the PEA that we did was done on the resource as of the end of 2024, because 2025 is just now being inputted in the block model. And it's a very, very robust project. And why it's so good? It's because the off-taker, which we're using for the residues is willing to pay a premium for the material because it has pyrite, gold, and silver, and it's very rich concentrate. So they need the pyrite for the smelters in Asia or in Europe. So they're willing to pay for that. So once we're up and running, we'll be producing about 1,100,000 ton of concentrate.
And that's a very interesting backstory, Boumadine. But you mentioned you have an updated resource coming out. You also have a very aggressive drilling program going on, 200,000 meters. Is that all for the updated resource?
So 90%. So of the 200,000, 180 is for the updated resource. And there's two program of 180, one this year and one next year. So 180,000 meters of drilling, and there's 20,000 meters that we keep for the regional because we also have a massive land package with other anomalies. Actually, we already have a gold discovery that we're drilling. So it's the land package at Boumadine is like 800 square kilometers. It's quite unique, so we're going to be spending and putting 20,000. Now, if we have a structure that we want to drill because it's really looking continuous, we always say, this is kind of the first pass on our geological program. We can double that or triple that. And look, January has been fantastic. As of January, we've already drilled 18,000 of the 180,000. So in 1 month, we've done 10% of the project. So drilling 18,000 is 24/7, 10 to 12 drills, the lab, the people. It's like running a library. You've got every meter is sampled, every meter is analyzed. So, but it's running we have a very strong geological team, very, very strong.
And you don't have to worry about the cold weather slowing you down.
No, but you know what? This year, rain. Morocco's got more rain than they tell us they've ever seen. All the dams are now full. They have water for the year. Agriculture is going to be great. At Zgounder, we have snow. We have water. I mean, this year they were blessed. Like for a dry country, they have water like never before. So sometimes we do have a day of delay if there's a lot of water, but on the drilling program, that doesn't affect anything. And at the mine, well, we have a stockpile. So if it rains or if it snows, we may slow down the open pit. The underground, they don't care. They don't see the difference. But the open pit, we can slow it down a little bit and we just pick it off the rum pad. So it won't show in the numbers, but it's good for us because it's bringing water to the site. It's bringing water to the population, which is extremely important because if you have a very dry year and you're the only one in the region with water and you're using that to treat ore, it's not very good. But it's not the case.
So let's summarize 2026 or your plans for 2026. Your focus is going to be on both development initiatives and also exploration at Zgounder and Boumadine. And if everything goes according to plan, your guidance for the year will be what?
So the guidance for the year is 5.8. And what we gave as a guidance, 5.2 to 5.8, because we know how sensitive sometimes people are with guidance. So we said 5.2 to 5.8 at Zgounder and 1 million plus or minus 10% at Boumadine. So looking to be at 6.8 to 7 million for the year. One's coming out at $22 all in, 23. The other one's coming out at 11. So very profitable year. When we looked at the year coming on the current silver price at $75, we're netting about $50 an ounce of operating cash flow times 7 million. It's about 350 million of operating cash flow. Very comfortable. But what's really important is it's giving us all the money that we need to develop Boumadine. Hence, there's no need to wait for the bank or for a structured credit or it's all from our cash. And that makes us go a lot faster on Boumadine. We can accelerate the tempo. And we in the past month, we've changed, in January, we've changed the approach. so that the sooner we can put that into production. Because once we put Boumadine into production and Zgounder on a silver equivalent basis, we're going to be like 43 million ounces of silver equivalent. That's a good size. Like yeah, we're going to be very well positioned and at an extremely good cost because Boumadine is high grade, easy to mine, very high density, so very much lower cost. So the ASIC at Boumadine is more like $12-13. So it's yeah, it's gonna be. We're looking forward to 2026, 7 and 8. I mean, we have a very clear plan of action here to become a really a mid-tier silver producer, and we'll have some gold that will kick in at the same time. And on top of all that, we're adding ground. You will see all the time. We add ground at Boumadine, we add ground at Zgounder. We keep increasing the portfolio. As I always say, it's like buying real estate on Fifth Avenue when nobody wants it. The Zgounder district or the Atlas district, for me, it's Fifth Avenue, or for others, they prefer les Champs-Élysées. So we're buying real estate on les Champs-Élysées or on Fifth Avenue, and we're just bringing it all in because it hasn't been looked at, hasn't been worked on. There's three. I mean, it's not going to be everywhere, but there's more than one Zgounder and more than one Boumadine in Morocco. That's for sure.
Benoit, I want to get your views on the silver market now because you are a silver producer. A big part of what you do is managing, I guess, the sales of silver. And given all the volatility that we've seen in the last 2 to 3 weeks, maybe you can just speak to that. I mean, one day it's at $70, the next day it's at 100. How do you manage that?
Yes, you're absolutely right. And to manage your sales, you have to be well funded. If you're not, then you're chasing, and then you fall into the trap of maybe I should hedge, maybe I should pre-sell because I'm not funded. We're extremely well funded. We have way above 100 million in the bank, so we are super disciplined, and we produce the metal. Few produce the metal. They all produce the paper. All the banks produce silver paper, and many traders have silver paper. We produce the metal, and the metal is needed to close these positions or for the industrial use. So we are extremely disciplined, extremely structured, and we looked at the market live 24/7. I mean, based between Morocco and Canada. And what we do is if we don't like the price, we don't sell. Like in Q1, we did not sell yet below $95. And why that is, it's because we're super structured. And also, once you have more metal, you show your hand and you show the metal. You're selling 200,000 ounces, 300,000 ounces. So if the market today, let's say we would sell today, the market's like $75. What we would do is we would put 50,000 ounces at 78, 50,000 at 82, 50,000 at 85. And all of a sudden, it's like, I always say it's like a Pac-Man. You know, when we used to play Pac-Man, it clack, 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 clack. And it eats you up till the last one, and then it comes back down. And because some people do want the metal. So it's quite interesting. We always do this, and we try to finish the month on a +1 or 2%, or depending. So we looked at the average price throughout the month, and our goal is to finish always better than the month. Some people say, oh, you have to sell to Asia and all that. That's complicated. You have to have inventory in Asia. You have to have a place of business, a residence. So you have to have an office in Hong Kong. So sure, sometimes on X, people say, oh, Asia is 120 and the United States is 80. But to get that 120, which probably lasted 2 hours that day, is you need a place of business. So it's not that simple. Sure, it can be done, but it's not that simple. But we trade in a very structured way. And so far, it's paying off. But I see the demand. It's there. It's continuing to grow. I believe the supply will be decreasing this year and next year. And I'm not taking into account here any change or accident in mining codes in developing countries, because I'm sure you've been following what's happening in Ghana, in Côte d'Ivoire, in Africa, North America. It's complicated. And now we had some issues in South America recently. And I really believe that the supply of silver will come down and the demand keeps increasing as more armament, more solar panel, more communication equipment, that just keeps increasing, and more demand as a financial instrument. It's going to keep increasing. And it's not true that everybody's going to take the silverware and ship that and get that melted. It's not, and it's not that much anyway. So so I think we're in for a beautiful ride. It'll be bumpy. So you got to put on your seat belt, and the seat belt, the quality of the seat belt is the quality of your treasury. If you have treasury, you're good. And you have no hedge book, you have no pre-sale, you just have your spot market, and you don't like it for 1 month, you know what? You don't sell for 1 month because you can always sell. So it's silver in the bank is as good as money in the bank. So we're very, very disciplined. But I believe we are heading into May and June and out of the turbulence once it does settle. You saw last night in Asia, there was a massive run on inventory. And these are real. This is real. Like it's silver that gets applied to contracts because there are all these crazy contracts. So a right business, right time, and in Morocco, right jurisdiction. And if you have all the planets aligned, we should be, as Rick Rule says, we will be creating generational wealth.
Great insights. Well, listen, I want to thank you very much for spending time with us today. And as we wrap up, Benoit, maybe you can just summarize for investors what they can expect in terms of news flow here in the coming months from Aya Gold and Silver.
Yes, absolutely. So look, you'll have drill results because we have 18 drills turning. So you have drill results coming out from Zgounder and the whole program, and drill results coming out from Boumadine. At the end of March, you'll have the Q4 financial and the year-end financial. We have started to see some of the numbers now coming from the bigger companies. I mean, it's looking very, very good. And obviously, because the selling price was fantastic. So the Q4 numbers and year-end are coming in at the end of March. After that, you'll have the Q1 production coming in April, which is also interesting. And for us, thank you for that asking the question, is we have our New York listing that's coming in, our NASDAQ listing that should be coming in Q2. We will file with we were just waiting for the fresh financial statements. So the 2025 audited financials, we'll give those to the NASDAQ, and then we're going to get listed 2-3 weeks after. And that will be a big bang. And then you'll have, the Q1 production, the Q1 financials, and more drill results throughout the year. Construction's behind us, and some update on Boumadine, because we're really accelerating Boumadine. So you'll get some construction update or development update throughout the year on Boumadine, and hopefully some additional acquisition of ground, because we are on that all the time.
Well, that's a great update. And once again, thank you, Benoit.
Thank you so much for inviting me again. Thank you.
Did you know that 80% of our viewers are not subscribers to our channel? So be sure to subscribe to our channel, Bloor Street Capital, and also hit that thumbs up button and leave a comment below. Thank you for your support. Maria, thank you very much for joining us today. You are the Senior Portfolio Manager and Chief Investment Officer at Sprott Asset Management, so you're the perfect person to speak to about precious metals. But before we dive in and examine your methodology, why don't I first ask you about the volatility we've been seeing in the markets of late? Silver started the year at $70 an ounce. It went as high as $120, and then one day we saw a significant pullback, 30%, which was the largest single-day pullback since 1980. And we continue to see these metals come under pressure here. Do you have concerns about the sustainability of this rally going forward?
Well, hello everyone, and thank you very much for joining me. Of course, volatility for portfolio managers could be good, could be negative. You always wonder how you will come out on the other end. But I think for us, we're long-term believers in gold and silver. And from that perspective, we are pretty much fully invested at all times. We kind of just sit and watch what happens. But so we don't really concern ourselves with the short-term swings. Of course, the rise in gold and silver towards last year, the end of last year and the beginning of this year was spectacular. And one could argue that maybe things got overheated. And so from that perspective, I always say nothing goes up in a straight line. You do need to have a view longer term, and we do. And I think we go from there. So am I concerned? I actually like pullbacks, and pullbacks are good because you can add to your positions, you can rethink your positions. I think in this case, volatility could be a good thing.
So if I'm hearing you correctly, this pullback that we have seen in the last week or 2 weeks, you're seeing this as an opportunity.
Yeah, I believe it is an opportunity for investors who, maybe in January, people began chasing particularly silver. If let's see how this plays out and how it settles out. But, silver just went on sale. Gold just went on sale. You can think of it that way. So certainly for those people who are interested in the sector, in the space, this could be an opportunity to add to positions.
And Maria, as I mentioned, we saw a day recently where silver dropped 30% in one day, but the biggest drop was in 1980 when it dropped 63%. And it was a totally different environment at that time. It had to do with the Hunt brothers and changes in margin requirements and other issues going on. But in the ensuing months, silver dropped 70% from its peak. Do you see this happening now?
That's a great question. You're of course referring to the famous Silver Thursday, when, as you mentioned, the Hunt brothers were forced to cover their positions, and they were trying to corner the market, of course. I think today is a very different situation in the sense that we don't have Hunt brothers trying to corner the market. We got to the silver price that we got to squarely on the back of fundamentals, I would argue. And it's a situation that's been building for years. We've been in deficits in the silver market. So, and again, we are not aware of, a Hunt brother type situation. And what happened at the end of last year, we did have a lot more retail demand, particularly in coins and bars. A lot of demand was driven by China, India, even the Middle East. So I would say it's a very different situation. And as I said, to us, silver has a long-term fundamentals. Demand is growing. And again, investment demand has been growing in addition to industrial demand, whereas supply has been stagnant to actually declining. And so I think it's a very different situation. I would be very surprised if silver lost 70% of its value again. Again, I think what's happened in the last couple of days, couple of weeks is a correction. I'd say they're very different situations.
Yeah, and I'm sure the market now is significantly larger than it was back in the 1980s, so it would be that much harder to manipulate.
Well, it is still a very, very small market. If you think about it, we produce about 1 billion ounces. We have supply of about 1 billion ounces a year, times, $80, that's $80 billion. It's nothing in comparison to some other markets. We have individual companies being traded for trillions of dollars in the market. So silver is still a very small market, and that's partly why it's so volatile, because it doesn't take a lot of money to push the price up or down either way.
So why don't we move on now and look at equities and how you value equities? And maybe why don't we just start at the very top, or with the top-down approach? What are your primary criteria for picking equities?
So we manage various portfolios, and obviously the criteria will depend slightly on the portfolio, but we do look around the world. We invest in North American companies. We invest in companies listed in London, in Australia. So we go looking around the world. Now, there's certainly size and liquidity constraints, and it depends on the stage of the company. So I think how we look at an exploration company will vary from how we look at a production company.
And you mentioned that there are size constraints, and I hear this from a lot of buy-side people, but do you have a minimum market cap that you look for before you make an investment?
We don't have a minimum market cap. Well, maybe kind of, I would say a couple of $100 million at least, but it's more about the liquidity of the name. Again, we have some portfolios that, you just need a certain size to have critical mass. Otherwise, adding a new name won't make a difference. So it is more of a how quickly can we trade it also. So we do look at liquidity particularly.
Right. So if I'm hearing you correctly, you got to be able to buy the name, but you have to be able to sell the name too. And in order for you to do that, you got to have the liquidity.
Yeah, absolutely.
And what about jurisdiction? Are there regions that you stay away from?
Yeah, as I mentioned, we do go global, but there's certainly some jurisdictions that we don't touch. For example, some areas in Africa, some areas in Asia. We do go to Latin America, North America, obviously. What we do is actually publish a map on our website on sprott.com, and that where we rank kind of almost not every country in the world, but a lot of countries, we kind of give it a ranking from 1 to 5, and anyone can go and pull it up online.
And what about valuation? Maybe you can speak to how you value an explorer co versus the developer versus producer.
Absolutely. So if we're looking at an earlier stage company, an exploration company, obviously they don't have production, they don't have cash flows or earnings. In that case, we pay, that much more greater attention to the deposit itself, right? And of course, in any company, we look at management, we look at capital structure, we look at, cash levels and balance sheet, all of that good stuff. But if we're looking specifically at the start of the chain at exploration, we pay a lot of attention to geology, to metallurgy. I always say, how big can it get? Basically, we're looking for things that can become a sizable mine. I'm not interested in something that can produce a small amount of gold, because there's just not much room for error there. There's very little margin for error, in fact. So I try to look for size and for the quality, and as you mentioned, jurisdiction. So there's a lot of factors, infrastructure is important also, where a deposit is located in terms of access to water, access to power, roads, all that good stuff. So there's a lot of factors that we look at. And as we move up the chain to development and then production, we obviously start layering on a potential mine plan and cash flow and free cash flow generation. And of course, that stems from the beginning, from the quality of the deposit, the size of the deposit, etc. So in terms of kind of what metrics do we look at, we do look across the board from price to NAV to price to cash flow, and of course, free cash flow. We also increasingly are kind of challenging management teams to provide us metrics of per share, and I think someone like Agnico talks about that. There are companies, more and more companies are talking about their per share metrics, which is fantastic. But we would like to make sure that management teams are placing emphasis on building mines in a, how do I say it, capital responsible manner, right? That they don't dilute shareholders a lot, that they use debt where appropriate and as appropriate, et cetera, et cetera. So there's a lot of things we consider.
And what gold and silver price do you use to value equities? Are you using spot, or do you use a discount to spot?
So I always say, for me, I at any given point in time, I will use something close to spot. And the reason for that for me is this way: I'm not making an assumption of where gold will be or silver will be in a year from now, 2 years from now. That kind of flat line is just something, and I can kind of compare a lot of different estimates, different companies. It kind of just equalizes everyone in that.
And Maria, how many names do you have in your portfolio?
Again, it'll vary, but our goal is usually to have between 30 and 40 names in the portfolio. Not too few where, you're not diversified, but also not too many where you can't track what the company is doing, what news they have coming up, et cetera, et cetera. So we find that 30 to 40 is usually a good size where you're able to also kind of layer in production, development, exploration. You can kind of vary by jurisdiction. It gives you enough room to play with the various factors. And like I said, at the same time, you're still able to focus in, and our team is able to cover the names quite nicely.
And a big part of your job is boots on the ground, going out to site and checking out the various operations. How many site visits would you do in a given year?
Yeah, so we try. Again, we have a team of about 5 individuals who are involved day to day. And I'm not sure how many a year, I guess. I know Justin does quite a few. I try to get out. We all try to get out and do a few a year, I would say. I mean, we also don't want to be out of the office too much, but we do try to and be smart about it. Like I always say, I like to combine site visits. So if I'm going to a foreign country, especially, I'd like to see a bunch of things all in 1 week so that I can, make it productive and make it efficient.
So I want to get your view on juniors as opposed to producers. We saw many of the major names like Newmont, Agnico, they took out their all-time highs, but a lot of the juniors have not. And I'm just going to use the TSXV as a basis for comparison. It's currently trading around 1,100, give or take, but still below the high that we saw in 2011, which was 2,400. And does this tell you juniors are still cheap?
Well, juniors are still cheaper. Even if we look at things like price to NAV, probably the easiest way to compare seniors to juniors, they are trading at a discount to the seniors. And that's natural because, again, as you're progressing of your company in the stage of development, your valuation should be increasing as you're going into production. So if you don't have production, you're not going to trade at the same multiple. Now, that also demonstrates to me that we're not at the peak of the market. I would expect the juniors to be flying high. If that was to happen, I would think that we're peaking, really. So the fact that we're not doing that tells me that we're still in the beginning of the bull market as opposed to the end.
So far this discussion has been focused on precious metals, but I want to get your views on some other metals. And the U.S. government has been very bullish on investing in mining. They've made a number of equity investments in a few mining companies. They've also recently announced the formation of a $12 billion critical minerals reserve fund. They call it Project Vault. And it's going to invest in what they deem to be critical minerals, okay? But what other metals besides gold and silver do you like?
Well, we actually do have products that give investors exposure to non-precious metals. So things like copper, lithium, nickel, we invest in steel, various things. If you were to ask me to highlight another metal, I would talk about copper. Copper is similar to silver in that there's a scarcity of good deposits. We've mined out a lot of the big copper deposits in the world. If you think about Escondida, et cetera, the big ones. So copper is also in a deficit situation like silver. And we like it going forward.
And before we wrap it up, you were trained by one of the greatest investors in precious metals, and that is Eric Sprott. What was the most important thing he taught you?
Well, I'll have to say Eric pretty much taught me most of the things. He truly did. I was very fortunate to work with him. And my question of how big can it get? Well, that came directly from Eric. Eric is always interested in finding big deposits, big mines. He has placed his emphasis on grade, so you know how rich the ore is. And he's an optimist, and I think if anything, I strive to be more like him in that sense, that he's always, you know, he believes, first of all, he believes in gold and silver very much, and he has for a long time. And from that, he just always, you know, says it'll work out. And kind of he believes in the stories. And if he likes a story, he'll go big. And I think that's another lesson for me, that if something is working, you kind of try to press that button more, and vice versa. So I think, you know, he's taught me a lot, and those are the big things. Kind of think big, be optimistic, and you know, increase the position if it's working.
Yes, and the other thing I always take away from Eric is the fact that you got to be patient sometimes in order for it to work out.
Well, that's like any resource investor, really. We have to be
and
patient.
Sometimes you might have to wait 5 years, but eventually
mining is a long cycle business. That's right.
And Maria, as we wrap up, there's a lot of investors out there that are watching this, and they're very concerned about the volatility we've seen in recent weeks. What would be your messaging to them?
And again, I think we touched upon this in the beginning, but I will reiterate. Again, mining is a volatile business. You know, it goes through cycles. I do believe we are in a bull market cycle right now. Corrections are healthy. They take the air out of a bit, which is healthy to me. Use the volatility to your advantage. You know, if you like something, be patient, as you mentioned, and add to your positions using the volatility. And have, you know, do your research on the metals as well. Don't forget, you need to believe as an investor. We wouldn't be doing this, what we're doing right now, if we did not believe in these things from a very fundamental kind of long-term basis. And I think that's message number one. You need to invest in something that you not necessarily know inside and out, which would help, of course, but you know, you need to invest in something you believe in. And also, I would say, Sprott.com, our website, is a great resource for investors. Not only does it outline all our products that we offer, which we offer a lot of different products, but we publish a lot. I say our marketing department is a machine. We do articles, we do webcasts, we do podcasts. We have a Sprott radio. So we try to educate investors about gold, silver, copper, uranium, you know, all these wonderful things. So I would highly recommend investors go to our website and explore it.
Well, Maria, this has been a great discussion. And once again, I want to thank you. Good luck in the markets.
Thank you for having me.
Shawn, thank you very much for joining us today. A lot has happened since the last time we spoke, which was in May of last year. The gold-silver ratio at that time was at 100, and now it's at 60, give or take. Can you believe that move?
I can actually, but you know, it's still up at, you know, 50 to 1 or whatever it is today. You know, I wouldn't be surprised if the next time we spoke it's at 30 or 25.
Let's hope so. So the other big event that's happened since the last time we spoke is the proposed merger of equals between Dolly, Varden, and also Contango Ore, which is a gold producer in the state of Alaska. Why don't we start right here? What was the rationale for the merger?
Yeah, it's a good question. So I want to start by just describing the journey we were on at Dolly Varden. And if you go back 6 years, in and around this time of the year, myself and a new team took over Dolly. And we were in a $16 price environment for silver. We had walked into a company that had two past producing historic silver mines in BC's Golden Triangle. And what we set out to do and what we accomplished over the next 5 years was we brought in a lot of capital. We brought in about $185 million. And the capital came from some very astute investors, groups like Hecla Mining, which is a $20 billion primary silver producer focused in the US and Canada. Investors like Eric Sprott, institutions like Fidelity. So we brought in the money, we built up a team, we went out, we did about 5 acquisitions. So we went from a 7,000 hectare land position to 100,000 hectares. And we went from 2 past producing silver mines to 5. But the most important thing I think we did was we let a team of scientists, some of them experienced, some of them young, come into the area and try to expand and extend known veins, but also look for new geological opportunities and try to make new discoveries. And they did. And so the company took off. It went from, a $20 million company. I think the highest valuation that we experienced in the last 30 or 60 days was $750 million. And so during that rise, I had a lot of investors say to me, when are you going to start producing? And I started hearing those comments when silver was $20. And my thinking was, it was more cost effective to acquire and explore than it was to develop and produce. And however, with the recent surge in the silver price, I think it's now the appropriate time to look to advance the project. Unfortunately, we as an exploration team don't have the skill set to advance the project through permitting into development. And, what some companies do is they hire, and they build up their team, but no company can avoid the Lassonde curve. And when the Lassonde curve was first introduced, the concept was, a company makes the exploration high and then goes through the development low, and then you only take out your exploration high once you're in production. And that was actually okay because that was typically a 3-year period of permitting, et cetera. However, what's happened now is that permitting timeline has been longer, and during a bear market, capital's been scarce. And so the reason we're doing a merger is we're doing a merger with a gold miner that has cash flow, that has the expertise to permit and develop, but most importantly, they've optimized a model called DSO. And that DSO model is one of the main principles behind the merger. They also have complementary projects that are going to be processed, we envision, at the same processing facilities. So we're in the same geographical area, they're high-grade projects, and there's complementary management skill sets.
That's a great overview, and I want to move on now and look at the assets between both companies and how they're going to complement one another. And I want to start with the Alaskan portfolio. It's comprised of 3 assets: the Mao Chao mine, the Lucky Shot mine, and also the Johnson Tract project. Why don't we start with the Mao Chao mine and just tell us about this? How many ounces does it produce? What is the all-in sustaining cost?
Yeah. So Manh Choh is an Athabascan word that means big lake. And what's really interesting about the discovery was the discovery has gone from feasibility to production in 3 years, which is almost unheard of. And the reason for that is it's a very special deposit. It's an open pit deposit in Alaska, open pit gold mine, grading 8 grams per ton. So it's one of the highest grade open pit gold mines on the planet. And the ore is being trucked. It's so high grade that it's being trucked 240 miles to Kinross's Fort Knox facility, which is one of these underutilized processing facilities that I mentioned. And the total production on an annual basis is about 200,000 ounces a year. And in order to minimize dilution and in order to accelerate its move into production, a joint venture was established with Kinross. So Kinross owns 70% of the Peak Gold joint venture. And the benefit there for shareholders is your operator is not a junior miner, it is Kinross. And so of the 200,000 ounces that are being produced on an annual basis, a third of that, or 60,000 ounces, are attributed to Contango shareholders. So in 2025, there was 102 million US dollars that was achieved from free cash flow. If we look at the life of the mine, the average AISC is about $1,500 an ounce. Now that brings me to the next project that's 100% owned in the company, which is Lucky Shot. So what Lucky Shot was Lucky Shot was a past producing permitted high-grade gold mine. So it produced about 250,000 ounces at 40 grams per ton. And what's happening at the Lucky Shot today is there's a drill program, an 18,000 meter drill program that started just before Christmas. And there's a planned spend on Lucky Shot of $50 million to bring the project back into production. And where we see Lucky Shot contributing to future production is starting in 2028, initially 30,000 ounces a year. So again, if you look at Manh Choh at 60,000 ounces, you look at Lucky Shot at 30 initially, and 30 will ramp up to 40 and then 50 in subsequent years. But you're going to have a path between the two projects of 100,000 ounces of production. Now that brings me to the third project in the portfolio, which is a project called Johnson Tract. And now Johnson Tract is, in gold terms, about 1 million ounces and about 10 grams per ton. So another high-grade gold Alaska-focused project. And, you know, the work that'll be done at Johnson Tract in the next few years is essentially camp upgrades and infrastructure improvements to get the project to a place where a production decision can be made. And so that'll contribute in the coming years. And what we forecast there is about 100,000 ounces on an annual basis. So there's a nice pipeline in Alaska for 200,000 ounces of gold production.
Okay, you mentioned direct shipping ore, and one of the things that makes Contango so profitable is direct shipping ore, or DSO. And because of this process, it eliminates the need for on-site processing and tailings facility. Maybe you can just expand on that.
Yeah, you know, it's really simple. If you think of a container, essentially what's occurring right now at the Manh Choh mine is the company's putting rocks in a box and they're shipping them up to Fort Knox. And whether you ship those rocks in these containers by road, which is happening at Manh Choh, or whether you put them on a rail or you put them on a barge, the idea is by not having to build a processing facility. You know, if you look at the North American landscape, there's a number of underutilized processing facilities. You can go, I can think of Red Lake, I can think of in Northwest BC, I think about the Yukon. There's a number of idled processing facilities. And these processing facilities, you know, need ore. And if you look at the way projects were developed historically in the North, it was the hub and spoke model. And what the DSO model allows you to do is, because you don't have to build your own processing facility, you're saving a lot on CapEx, but equally important, because you're not permitting a tailings facility, your time to permit the mine, you know, is contracted. And, you know, it's just a win-win from a capital, from a time, also from an environmental standpoint. Having one facility where you have one tailing site versus a number of other ones, it's a huge benefit. So now the challenge, though, is this only works with high-grade projects. And so our focus at Contango and Dolly Varden is to focus on those projects that are the highest grade projects. I mentioned, Moncho at 8 grams, Lucky Shot's current resources are calculated around 14, Johnson Track at 10. And then if we go down to the Kitsault Valley, where Dolly's flagships are, you've got Homestake's indicated resource at 7 grams, the Dolly Varden Silver at 300.
Shawn, let's move on now and discuss the Dolly Varden assets now. And as a reminder, it's a pure high-grade silver project in the prolific Golden Triangle area of northern British Columbia. And when it comes to mining, size and scale is very important, and you already have 100 million ounces of silver. But Shawn, why don't we talk about the grade now so we can further emphasize the uniqueness of this project?
Yeah, what makes Dolly Varden really unique, and really stands out amongst a small group of peers. Primary silver mines are rare. They're extremely rare. Most of them are found, though, in places like Peru, Bolivia, Mexico. It's very unusual to have a high-grade primary silver mine in Canada. And so what makes the project so unique is we're hosted in a Jurassic Age rock, the Hazelton Formation in the Golden Triangle. And the Golden Triangle is home to big projects like Eskay Creek, which is probably one of the most significant, profitable gold silver mines in history. You've got the Premier deposit, which was the most profitable gold mine in North America when it was operating. You've got Brucejack, which is currently being mined by Newmont. It's one of 2 big operations they have in the Golden Triangle. Really, the Golden Triangle, because of its density of projects, because of its infrastructure, and because of its support of First Nations, is really the number 1 destination in Canada for current and also future potential. And so what we've established in that prolific mining camp is a 100,000 hectare land position that incorporates 5 past producing high grade mines. But we've, in addition to a lot of silver and the potential for a lot more silver as our drilling has produced expansion, extension, discovery, new opportunities to follow up on, there's a tremendous amount of gold. And what I've learned in the 20 years that I've been in the business is what often starts as a silver mine. And if you think about melting temperatures, gold has a much higher melting temperature than silver. As explorers move from the silver mineralization and you transition into the gold, what's happened is explorers, developers, and miners in BC's Golden Triangle have started with high-grade silver deposits, and they've morphed into some of the biggest gold systems on the planet. So yes, we have a lot of silver. Yes, that's unique. It's primary silver, but we have also complemented with a lot of high-grade gold.
And as I mentioned, you already have 100 million ounces of silver. How do you take that to 200 million ounces? What are your plans going forward?
Look, we've got a number of targets. For example, we put out some results in January from our Wolf vein. So the Wolf vein was all but non-existent a few years ago because the Wolf vein is projected below a sedimentary cover, and it had never been explored in the history of the project below that sediment cover. Where we've seen a lot of success is by following that vein in the contact between the sediments and the Jurassic Age Hazelton Formation. And in that zone, we're seeing a really rich, high-grade vein that's swelling out to 30, 40 meters in width. And the average grade is about 300 grams per ton. It's still open. It's not part of our existing resource estimate. So there's a lot of opportunity there. What's interesting, though, in that announcement that I was referencing that came out in January, there's a fault, the Central Valley Fault. On the other side of that fault, we hit mineralization that doesn't look like Wolf, it's right next to. It looks more like Torbrit, which is a mine we have on the property, it's a past producing mine. It was Canada's third largest primary silver mine. And we found Torbrit style mineralization a kilometer away from Torbrit. And so when we think about growing silver in the tens of millions of ounces, potentially, you talk about how do you go from 100 to 200 and beyond. Well, we made another find 20 kilometers north on a newly acquired property called Thea, where we're seeing that same signature that Torbrit has. So look, I think there's a tremendous amount of potential, but what I'm more interested in at $100 silver is I'm more interested in an economic plan to get these projects back into production. That'll fuel the advancement of looking for more. Ultimately, I think when these major mining companies look at these districts, they want to see 100 million ounces of silver, 300 grams per ton. That's a world-class camp. But they want to see the potential to go to 400 million ounces. And I think the Dolly Varden, because of the land package and because of some of that evidence, I think we're starting to see that potential show itself.
And Shawn, once the deal closes, are you going to spend more time or more focus on the gold assets in Alaska? Or are you going to continue to focus on the silver assets in British Columbia? In the past, you've been very aggressive with the drilling. Are you going to continue on with that?
Yeah, so one thing that's great about doing this merger, if we were to stand alone and advance as an independent company, we would have to pick development or exploration, right? We would only have the resources to fund one endeavor. But what's great about the merger is because of the cash flow, because of the strong balance sheet, we can do both. And so we're drilling just as many meters this year as we did last year. The only difference is we're being complemented with the other projects drilling. So our shareholders are actually, who are limited to a seasonal drill program, now have year-round exploration on multiple projects, more meters. And so it's really, it's a plus. And so that's a big benefit. So we're going to continue to aggressively grow, but we'll be backed with that cash flow.
And Shawn, you just touched on the fact that because of the merger, you're going to have access to a lot more cash flow. Maybe we can talk about your balance sheet now. How much cash do you have on hand, and how do you think you'll allocate that in the coming months?
Yeah, so the merger vote is on March 17th. So we are forecasting that the merger will be complete by the end of March, at which time we'll have about $140 million of cash on hand. We'll be generating about $150 million of free cash flow. And if you look at our budget for the year, which includes the big drill program at the Kitsault Valley, it's fully funded. The drill program at Lucky Shot, fully funded. And the work that we're doing at the Johnson Track, which is a year of infrastructure improvements and camp upgrades, that's fully funded. So the company is in a really strong financial position, strong balance sheet, and ongoing cash flow.
Shawn, one of the unique elements of this deal is that you will be a gold producer with the potential to become a silver producer, and you have said that you want to become the next Hecla. Can you just expand on this? What exactly do you mean by that?
Yeah, if you look at the landscape right now, and if you're an investor who's looking to get exposure to silver and gold, and jurisdiction matters to you, there's really only one choice in the market, which is Hecla Mining, and it's a great business. It's a business that's been operating for over 100 years. What we're trying to create here with the merger is another choice for investors. Those investors who are looking for safe jurisdiction exposure to gold production, a big silver inventory that will be in production. It was one of the great mines in previous cycles, Canada's third largest primary silver mine, the richest silver mine in the British Empire. So we're creating a vehicle that'll be valued at about $1 billion in a marketplace where there is no peer like it in that mid-tier space.
Well, Shawn, this has been a great overview, and I want to thank you very much for spending time with us today and telling us about the deal. As we wrap up, maybe you can just share with investors what they can expect in terms of news flow here in the coming months.
Yeah, so we just had some drill results from Homestake and Wolf recently at Dolly Varden. Next on deck is some drill results from the Lucky Shot, which is in the Contango portfolio. We have a very important date coming up in March. March 17th is the special meeting where our shareholders will vote in favor of the transaction. And then the merger will complete at the end of March, and we'll be moving forward as an entity that's got four districts, one producing, one soon to produce, and a lot of growth in the pipeline.
Well, Shawn, thank you very much for spending time with us today, and congratulations on the recent merger.
Thank you very much.
Hi, it's Jimmy, and I hope all is well with you. Before we get on with the interview, I have one small request. Follow me on Spotify and Apple Podcast, leave a rating, and leave a comment. And if you have any suggestions on who you would like to see interviewed on the channel, let us know in the comment section. Thanks for your support. Walter, thank you very much for joining us today. Eskay Creek is in the Golden Triangle region of northern British Columbia, and Eskay Creek was a past producing mine, and it has a very rich history of both gold and silver production. Can you provide us with a little bit of backstory on Eskay Creek?
Yeah, Eskay Creek was a legendary underground mine. It's located in the northwestern portion of British Columbia in an area commonly referred to as the Golden Triangle. It operated originally from 1994 until 2008, and it produced 3.3 million ounces of gold and 160 million ounces of silver in its 14-year production life. The thing that really sets it apart, though, was the grade. The grade of the gold was 45 grams per ton, and the grade of the silver, which was mixed in with the gold, was 2,200 grams of silver per ton. So when Eskay operated, it was the highest grade gold and silver mine in the world for those 14 years.
And so I guess that begs the question, why did Barrick shut it down or get rid of it?
Everybody always asks me that question in the first bunch of years that we were trying to raise money with Skeena. Nobody believed that there could be anything left there of economic value because Barrick's a smart company, and big companies like Barrick don't make mistakes, and they are a smart company, and it's all about the context and the time. When Eskay operated back in the 90s, there were three big differences back then versus now. The first is that there was a government in British Columbia that was hostile towards mining. Like in the 1990s, a lot of mining companies left British Columbia. It was considered difficult to impossible to permit an open pit mine during that time period. So you could get an underground mine permitted, and that's what the previous operator did. The second thing is that the cost of operating that mine was very high because it was a diesel and propane powered mine. And in the early 2000s, when oil hit $100 for the first time ever, $100 a barrel, I was told anecdotally that energy represented more than half of the operating cost up at Eskay. So fast forward to 4 years after they shut down the mine, in 2012, another company came and invested $2 billion to build a hydroelectric facility right next to the old Eskay mine. So now as we revitalize it, energy will represent less than 5% of our operating costs. We have a life of mine contract for power at 4 cents US per kilowatt hour, extremely cheap. So we have a much lower cost structure than they had historically. And then the third massive difference is that the price of gold and silver are very different. Like, on a gold basis, I think the gold price averaged like $300 an ounce during the time period that they operated this mine. Obviously today we've got $83 silver and $5,000 gold. We have a much more attractive selling price environment. So we just sum up the three things that changed. The regulatory environment improved in the late 2000s and teens. You could get an open pit mine permitted, so that didn't exist when Barrick operated. 2, Barrick had high energy costs. Now we have cheap hydro. And number 3, Barrick had very low selling prices for gold and silver, and now we have much higher. So that's what makes the mine work years later after Barrick gave up the asset.
And you mentioned the price of electricity is 4 cents per kilowatt. So I want to put that into context. Maybe you can compare. How does that compare to other provinces or other states?
Well, I think the right way to think about it is that, let's say you have a project up in the Northwest Territory or in the Yukon, and you've got to truck in all your diesel on an apples to apples basis. That energy is probably costing them 50 to 55 cents per kilowatt hour as a source of energy. Where on hydro, I was saying 4 cents US an hour. In Canadian dollars, it'd be like 6 cents Canadian per kilowatt hour versus 50, 55. So it's a huge game changer if you're connected to the grid versus if you're trucking in, diesel or propane to a northern project.
Now, you touched on the government a couple of times, and once again, when it comes to permitting, this is crucial to getting anything done. And Skeena recently received its Environmental Management Act, or EMA, permit, and this will enable the company to move forward with construction and eventually production. But the BC government has been very progressive in moving projects forward, and in doing so in a very expedited fashion compared to other provinces. Maybe you can just speak to the type of support you've gotten from the provincial government in getting your permits.
Well, I will say your description makes it sound, all really nice to be operating in BC. And look, let me tell you, the blunt reality is I felt like the government of BC didn't want to mention the word mining for the last decade, and it's only since Trump got elected that the threat of tariffs and the impact on jobs in BC, and the fact that the NDP government, which is the current government in power, almost lost the last election by a single seat to the Conservatives, that their feet are held to the fire. If the economy doesn't improve and if jobs don't become more prevalent, and they don't figure out a way to solve the current provincial budget deficit's 12 billion Canadian dollars. So there's massive pressure in the province of BC to come up with more tax revenue, and also I think Canada as a whole wants to sort of diversify their economic ties. So all those factors come together where now, mining is no longer a bad word in British Columbia. Suddenly in the last, 18, 24 months, suddenly we've had amazing support from the government, which is translated to us, receiving our final permits, in the last week. So we are now fully permitted to go into operation. I will say we took a risk and built half of the project before we got our final permits, because it's a race to get to cash flow. I sort of copied Elon Musk's strategy. What he did with the gigafactories was he would start building them before he got the permits. The risk you take is if you don't get your permits, you may have to tear everything down, and that would be a horrible outcome. But look, as a management team, we're in the business of managing risk. And we felt like it was a calculated risk that would allow us to be in cash flow by 2027 versus late 28 or 29 to go ahead and start building. So we're halfway built at this point, and now fully permitted.
And before we move on and look at the project in more detail, I just want to spend another minute on the Golden Triangle for those who aren't familiar with it. But there's already a number of producing mines there. There's a lot of infrastructure. Maybe you can just speak to that.
Yeah, look, the Golden Triangle is famous for a reason in the mining sector. It's because it's been a prolific area for copper, gold, and silver deposits, going back for over 150 years. So the people in those northern communities, they know and understand mining, and many of the communities have provided employment to those mining projects. It's an amazing thing when you go into a small village or community, and you meet someone and they say, oh, my uncle worked at that mine, and my grandfather worked at that mine, and my sister worked at that mine. I mean, that's what it's like up there. I mean, mining is an integral part of the culture and the communities up there. And I like to say, if you could find a deposit up in that area, there's a very high likelihood you will get your permits and be able to bring a mine into production there. Unlike, you think about the alternatives. I mean, places like I don't want to pick on Barrick, but they went and spent $4 billion in Pakistan, and there's a story in the Wall Street Journal today about how that project, it's in Baluchistan, and the communities there's insurgency, and then you know, incidents in West Africa where assets get nationalized and mining executives get arrested, or sometimes even worse things are happening in Central and South America at mining projects. Look, let's not kid around. Canada and Australia are the two best jurisdictions in the world to be building mines. And within Canada, the northwestern section of British Columbia is a tier 1 jurisdiction.
Well said. So why don't we move on now and look at the Eskay Creek in more detail, look at the economics. And a definitive feasibility study was conducted in 2023 or released in 2023. Maybe you can just touch on the highlights of that study.
Yeah, so I mean, it's funny to talk about a study from 2023 because I mean, so much has changed in the world in the last 3 years. I mean, the best glaring example are the changes in the price of silver and gold. I think when we did that study, we used a gold input price of $1,800 US, and I think the silver price we used was probably $23 US. So, like we're so far above those prices now. But I guess you could look at it as, if, and this is not what I think is going to happen, if silver and gold prices were to absolutely collapse, what would this mine generate in terms of free cash flow? And the answer is that if we went back to those commodity price inputs from 2023, this mine in the first year of operation would generate $513 million of after-tax free cash flow. And then over the next, call it years 2 through 6, we'd average anywhere from $240 to $370 million of after-tax free cash flow per year. Okay, you wanna know what it looks like today? Today, using spot price, our after-tax free cash flow averages $1.4 billion US dollars a year in years 1 through 6. I say years 1 through 6 because the grade of the mine comes down starting in year 7 and the production falls down. But we will be coming up with a feasibility study update or mine plan update in the latter part of this year, where we bring in some other satellite deposits so that we are able to maintain that grade up at the 5 to 6 grams per ton. Now, that's an open pit grade. That's most underground mines. The average underground mine grade is 5 or 6 grams, but we have an open pit that is right now in a feasibility study being mined at 5 to 6 grams per ton. I think it averages 5.5 grams for years 1 through 6. So, what the feasibility study showed is that this will be one of the lowest cost open pit gold mines in the world when it is in operation. It'll be on the bottom 10% of the cost curve. So it's a monster free cash flow generator once it starts production.
And so you talked about the gold component. Why don't we talk about the silver component? Because there's going to be a large silver component to this. What will that do to the cash flow?
Well, I mean, it's an enormous kicker. I think the silver, in terms of its economic contributions, around 40%. We're going to do, we average 9.5 million ounces of silver a year in the first 5 years. And then over the life of mine, the average is 7.7 million ounces of silver a year. This will make Eskay Canada's largest silver mine when it comes online and into operation. The gold's 2/3 of the economic value. So, if you put the two together, if you called it gold equivalent, it's like 450,000 ounces a year. It'll be Canada's 5th biggest precious metals mine once it starts operation in 2027.
And Walter, when in production, how many ounces or gold equivalent ounces will be produced, and what will be the all-in sustaining cost? Yep. And I know you're going to be using numbers from the feasibility study conducted in 2023, but... Yep.
The all-in sustainable cost on a gold equivalent ounce is $684 US per ounce. That's the all-in sustainable. That's over the life of mine. In the first 5 years, the all-in sustainable cost is $538 per gold equivalent ounce produced. So in a $5,000 selling price environment, our margin's 90%.
And once again, that very low all-in sustaining cost has to do with the silver component.
Yes, the silver component is very important to the overall economics of the project, for sure.
So why don't we move on now and discuss your balance sheet and also funding in order to construct this or move SK Creek forward. You're going to need a lot of capital. Can you just speak to that?
Yeah, I'll start by saying we're fully funded. We did a project financing package with Blackstone and Orion back in June of 2024. It was a $750 million US financing package. And to put that in perspective, the CapEx in our feasibility study was 560 million US dollars. So we overfinanced, what we needed, but partly that's to cover overhead and some of the benefits that we're sharing with the local communities. So we're fully funded since, basically for the last 18 months. That package was composed of a $100 million equity injection, a $200 million stream, a $350 million senior secured credit facility, and a $100 million cost overrun facility. We've taken the equity from Blackstone Orion. We took the $200 million stream, which is honestly the most painful part of the whole thing, because when you do a stream, you're forward selling gold. So we forward sold in June of 2024 $200 million of gold. We didn't touch the silver, by the way. We purposely did not want to impact any of the silver production. So we only sold a stream on the gold. And we sold $200 million of gold at $1,800 an ounce. Now gold's $5,000. That's painful. But thankfully, I negotiated a right to be able to buy back 2/3 of that stream at an 18% IRR. So we fully intend to exercise that right and buy back 2/3 of that stream. And it's probably going to cost us $200 million at an 18% IRR. But if I didn't have that clawback, it would cost us $600 million to buy back this whole thing. So I feel quite strongly that management teams of mining companies should not sell royalties or streams, that we have a duty to our shareholders to protect the optionality on the silver and gold price. I'm super bullish on silver, super bullish on gold. And, I think as a manager of a mining company, we shouldn't be giving up that optionality. We should protect it in every way that we can.
Interesting points. Now, is there a time limit on when you can buy that stream back?
Yeah. So contractually, I'm not allowed to buy it back until we start production. But I have entered into negotiations with Blackstone and Orion to try to buy it back like in the next 2 months. And I'm trying to coordinate that with a refinancing. I haven't drawn on the senior secured credit facility from Blackstone and Orion. It's priced at like 12-13%, super expensive money. When I did the financing package, I always envisioned that after I got the permits, I would try to go replace that with lower cost capital. So right now we're working with KKR and Bank of America on a potential high yield bond deal where we would replace the senior secured credit facility and the cost overrun facility. That would be $450 million. We'll replace that either with high yield bond debt or private credit. And then we would layer on top of that some additional funding to buy back the 2/3 of the stream.
And I'm curious, given the volatility we've seen in both the gold and silver market of late, what sort of feedback are you getting when you meet with these bankers or investors?
Yeah, I would say that when the investors see the kind of cash flow that this project is going to throw off, I mean, they're like clamoring over themselves to say, I think they want to have more exposure in their portfolios to hard assets, and in particular gold and silver. Especially in the backdrop of the current market where people are just getting crushed on these software services company. It makes having, in a portfolio, having some meaningful exposure to gold and silver all that much more important. And so I'm seeing it in the behavior of the investors that we're meeting with, that when we present to them, they're like, wow, wow, these things are unbelievable. The cash flow that comes out of these projects at these kind of commodity prices. And I think it's going to go up.
Yes, it's all about owning hard assets now, whether it be gold, silver, oil, whatever it is.
Yeah, agreed.
So this has been a great discussion, and I want to thank you very much for sharing your thoughts. This is a new name for me, so thank you for introducing me to the story. Now, you've already discussed a lot of detail on what's happening here in the coming months, but maybe you can just summarize for investors what they can expect in terms of news flow here in the first half of the year.
Yeah, sure. A couple catalysts. We just got all our permits. I still think I still don't think the market's completely absorbed that this project as of last week is fully permitted all the way. We're fully funded. Upcoming catalysts will be the refinancing of the Orion Blackstone debt and taking the interest rate down from 12, 13% down to hopefully like 8.5. That's the first catalyst. Second catalyst is going to be the buyback on that stream that I mentioned. Being able to buy 2/3 of that stream back is, I think, really important to the economics of the overall project. Both of those things I would see happening in the sort of March, April timeframe. And then, looking further in the year, the next massively important catalyst is going to be the mine plan update, where we show how we're going to extend the mine life and maintain a 450,000 ounce a year production profile for at least 10 years. And what that means is that cash flow, that like at spot price, 1.4 billion a year US dollars of after-tax annual profit, is not just years 1 through 5 or 6, but years through 10. So that's a hugely important catalyst later in the year. Timing on that is probably October, November. And then, probably the most important catalyst of everything is cash flow. And so every month that goes by, we're moving closer and closer to cash flow, finishing the construction. The project is halfway constructed now, and over the next 15 months, we'll finish construction. And everybody knows the Lassonde curve. Like, it's not like our project is going to re-rate the day after we start production. Investors will front run that. So as we get closer and closer to production, I would expect the share price to gradually grind higher. And I can't leave your viewers without some sense of answering the question, how do I think about how I'm going to make money on this thing? And to me, it goes, well, what could this thing be worth once it's in production? And I think there's easy ways to figure that out. You look at other companies that produce a similar amount of gold and a similar amount of cash flow. I would throw out like a Lundin Gold or even an Artemis, and you could see there's Lundin is trading at like 26 billion Canadian dollar market cap. Artemis is like around 10 billion Canadian market cap. We're going to be somewhere in between those two, is what I would think. Now you could take like after-tax cash flow and say, what are mid-tier gold producers trading at? On an EBITDA basis, mid-tiers are trading like 7.5 times the EBITDA. We're going to do 2.1 billion of EBITDA here, right? So 7.5 times 2 billion of EBITDA is like a 15 billion US dollar market cap. Our market cap today is 4 billion. So look, there's a huge re-rate when you go from having no revenue to having an enormous amount of after-tax free cash flow. So that's the opportunity for your audience, is to participate in this last stage of the Lassonde curve, where we are moving closer and closer every month to generating cash flow.
Well, I always like to finish on a high note, and I think you just did that. It sounds like the economics associated with this project are going to be quite impressive. Walter, once again, thank you.
Thank you. I really appreciate it.
Michael, thank you very much for joining us today. I want to jump right into it. We have seen some incredible volatility in the markets here in the last few weeks. These software companies have gotten pounded just because of AI replacement. Bitcoin is down 50% from its October high. Looks like it wants to go lower. And silver had its biggest one-day drop since 1980. And I want to talk about all of these sectors. But the first one I want to dig into is the silver sector. And I've been long gold for the last 2 years, so that's worked out well. But I've had very little exposure to silver, and I think it just got away on me. It just went too far, too fast. And now we've had this nice pullback here. What are your thoughts? Is this a buying opportunity?
Yeah, I think so. All of our work from various vantage points, not just momentum structural analysis, but relative performance analysis of silver versus gold versus the S&P. In other words, what's the macro trend of the monetary metals? Okay, thumbs up across the board. Gold miners, gold, silver. Okay. Then within that asset category, silver is outperforming gold. Oh, yes, it got shin kicked in 1.5 days. That's how long that drop lasted, but 1.5 days. Now we spiked that out last week I think on Friday or so. We spiked out that low, but it quickly came back up. But most of the drop was literally within hours. Okay. Now people thought that's it, it's over, done. You don't have that kind of drop without a top. Our work says no. You did not break anything except sentiment. Long-term momentum trend factors are not even near points of structural breakage. Whereas in the past, when we made tops, 2011, for example, or the low in 2015, there was ample structure on momentum where you could look at a momentum chart and say, oh boy, you break that line, you're going down. Oh boy, break that line, you're going up. We don't have any structure nearby. And whenever you do not have clear bridge over the River Kwai type structure to blow up, to break down through, you probably aren't at a top. Almost all tops, I'd say 95% of them, have clear momentum structures that when broken, then you later find out price joins in. Anyway, so the answer to that question, yes, silver got trounced. However, I think it is a buying opportunity for those who might not have been in the first move. And I think that we're still going to probably $300 to $500 silver this year. And probably much of that occurring by summer. As crazy as that sounds, it is not crazy. There's many examples of other markets doing similar type repricing to a new reality type events. Silver has all kinds of arguments for it, both technical and fundamental, that favor that sort of rapid readjustment. So our assessment says, yes, full thumbs up. This is a buying opportunity. In our weekend report, we put out some defining numbers where if we get above certain numbers this week, for example, in silver or gold, it says, yeah, you better get back on board if you got out. So yeah, I think that's the prime event of the year right there coming up.
So once again, your new target on silver is $300 to $500 by sometime in the summer.
I cannot be any more precise, unfortunately. The tantrum type move that is, having lived in a half a century range between $4 and 50 back and forth for a half a century, while nothing else did hardly. Copper didn't live in a range that long. It lived in a similar range as silver did for 50 years. It remained in a range from the 70s, 80s, 90s, 2000 into about late 2005. Copper said, oh, I'm no longer going to live in a 50 cent to $1.50 a pound range, which is where it lived. Instead, in a couple of quarters, it went to $4.50. Bam. Okay. No particular nuclear reason for it. It wasn't in sync with gold or silver at that point. It wasn't even in sync with other base metals. It just said, I'm going to a new reality. A couple years later, in 2007, lead did the precise same thing. Lived in a range for decades and decades. Said, oh, I'm out of here. Boom. Quadrupled in nearly a couple quarters. And if you look at gold, going back to when it was legalized 75, 50 years ago, it never stopped at its old highs. Made a high at $200 and went down, made a high at $850, went down, made a high at $1,200 almost, went down, and now we're, et cetera. So it wasn't confined in a 50-year box. Why was silver? Okay. Well, there's, explanations for that. Anyway, I think that not just the actions, prior archival actions of copper and lead, for example, or look at the price relationship of silver to gold, for example. It's ridiculously low historically. In fact, last year, it was down 1% of the price of gold. Divide an ounce of silver into an ounce of gold. 1%. Okay. If you go back and look at the bull market surge that peaked in 1980, in fact, for a period of time there, not just a spike, it was at 6.5% of the price of gold. Okay. Then in the 2011 bull market, 2010 to 11, the latter part of that bull market, silver was over 3% the price of gold. So last year it was 1%. What do you think? It's going to free? Okay. So it's popped up over 2 recently. breaking out over a massive, clear technical structure on the relative performance chart, meaning an ounce of silver divided into an ounce of gold plotted each month. And you had a very clear ceiling, and it broke through that. So that's yet more evidence that silver is waking up even relative to gold. And yes, we had a sharper pullback than gold just recently, but it's still outperforming gold when you go back a year, 6 months, etc. So we favor silver over gold, and we think this is a buying opportunity.
And I'm sorry, your $300 to $500 target, that's quite a wide range, but that's based on a percentage?
Lots of things. First off, let's look at gold, the mama. It's had two big bull markets since, well, it got legalized in 75, and it was already at 200, and then it dropped down to near 100 by 76. Okay. From the 76 low to the 1980 high, it had an 8-fold gain. In other words, if you bought gold at the low, you made 8 times your money by 1980. Then it dropped and plateaued at a much higher level than it had been before. And in 2001, it made lows around $260. And it had an 8-fold gain to get to its 2011 peak. Different span of time, 10 years as opposed to about 3. But same dimension move, 8-fold. Okay. We made a bear low at 1,050 in 2015. We're now only 5-fold above that level. And yet everybody says gold's overbought. Heck, it hasn't even matched the performance it provided in the prior 2 bull markets under far less monstrous fundamental factors in play. So even if it just matched the multiple gain of those 2 bull markets, would be $8,500. And by the way, we've been saying that for a year, not as a target, but just as a get back to what we've done before type thing. JP Morgan has now come out just recently and come up with the same number. Isn't that cute? Anyway, but if gold went to the 8,500, okay, let's just say, okay, that's all it does, match the prior bull markets. And silver went to 3%. I mean, that's where it was in 2011. Okay. Whoa. What's that, $240, $250, something like that. Okay. I don't have my calculator. If silver went to the levels it was relative to gold in 1979, 1980, it'd be 6-fold above that level. Now, here's another, and that projects up toward the 500 level. 2 other factors to look at. One is just simply monetary degradation. Look at an M2 chart. Go back to 1980 or 2011. See where the M2 was then. See where it is now. What's the gain? If silver were to match that gain, it'd be in the several $100s just to be where it was in real buying terms in 1980 or 2011. And there's another thing to look at. A stupid, simple price chart. There's 2 charts you can look at. One's arithmetic, meaning dollars on the left side. And you've got that 50-year range, and the thickness of that range is like a box, okay? It's a $4 to 50. Let's call it 5 to 50. So it's a $45 thick range. Added to the top of the range, $50. So when it broke out, your quote swing objective orthodox method would be $95. Look what happened when silver got up to 93 to 95 a couple weeks ago. There was a fight. There were a lot of sellers there saying, swing objective met. Okay, boy. And they got a little bit of sell-off and then blew their head off, went to 121. So obviously the arithmetic scale swing objective is invalid because we went way beyond it. Okay, but if you put it on a logarithmic ratio scale, just like I was talking about with gold, if you'd put that gold on a log scale, you'd see the 8-fold moves of equal dimension on a log scale chart. If you put silver on a logarithmic scale and add it to the top, it says $500. Why? Because the low of that range was $4 or $5. The high was 50. That's a 10-fold dimension gain from bottom of range to top. Add 10-fold to 50. Okay, enough reasons, right? Okay, and usually these changes in reality, where a market says, "I did something wrong for a long time. I'm going to adjust it." you have a tantrum. You don't do it incrementally, crawling all your way up. You suddenly burst to correct for the error before. You often will overdo what might be justified. So if, let's say, 250 or 300 is fully justified, then maybe they overshoot it. It's typical of markets that are correcting for excess. Anyway, those are some multiple reasons why we still assess that, nope, our assessment months ago, silver going into the hundreds. It's probably going to do it within a couple quarters. This correction occurred when? At the end of the second month of the surge. Surge defined by when silver broke out versus gold on a spread basis. That was the close of November. Okay, January, February. And then it has this correction. Earlier than we expected. We thought we might get one about midway into that 6-month period. But we still think by summer you'll likely be at very high levels.
Now, one of the reasons why I've always had a larger weighting toward gold is because it's a lot more stable. And it's a lot more, the market itself is much larger and it's much more mature. And, to see gold move 10% in either direction is very rare. Whereas silver, I mean, we saw it rip it was up 70% in the first few weeks of this year, and then it dropped 30% in one day. And to me, that's kind of concerning. Are you not concerned by that kind of volatility?
Well, yeah, sure. But it's from an investment grade point of view. And I'm even talking investment grade like 6 months, okay? Silver is the place to be by every metric we can measure against gold. And it will likely outperform gold as it has. In fact, if you go back a year, it was 1%. Now it's 2%. That means gold in relative value to gold over a year. So while gold's gone up over the last year, since early 25 to the present, silver's more than doubled, despite the pullback, than what gold has done. Yes, with more volatility here. But again, the key issue for investors is what was your point of entry? If your point of entry was finally, oh gosh, I believe it now, I'm going to buy it at 120. Okay, well, you got bagged. And maybe you should have been. Our buy levels were last June coming up toward 35, and at the close of November in the 50s. Those were our last two major buy signal levels. So yeah, we gave back some profits, but on the other hand, nothing alters our assessment. We shall see.
Now, I want to play devil's advocate, and as I mentioned, silver dropped 30% in one day, and the last time we saw a move like this was in 1980. And on March
in the range, yeah.
On March the 27th of 1980, it dropped 63% in one day, and then in the ensuing months, we saw a lot of chop back and forth. But long story short, it lost 70% of its value. You don't see that happening now?
No, I don't. If this were 6 months into the move, and if silver had reached $400 or $500 or something like that, I think you would have a sharp correction from there, but not back to $50. The old reality's gone. The question now is, where is silver going to define the extreme upper end of the new reality? And I think it's going to do it very rapidly, meaning in a handful of months, not 3 years. And I think once it does, it'll probably overshoot and probably collapse from there. If you got in at $400 or $500. The issue is, did you get in at a proper time? And I think happens to be right now is the proper time. You've got to pull back, use the opportunity. And most of our measurements are fairly long-term when we analyze markets. We're looking for the big moves. But even when we get down to the micro stuff like daily momentum or weekly momentum, which we included in our weekend report, when we analyze that, we can even see buy trigger levels, of which like daily momentum today is already crossing a buy trigger level. Short-term momentum saying, hey, I'm out of the hole now, okay? The weekly offers a number about $6 above today's high. If you get there this week. Next week, that'll adjust down some. So even the short-term stuff is saying, hey, I'm out of the hole, okay? So at that point, I would say if you're not in silver, join in. Yeah, you're buying it off the low, recent low, but you're buying it well below the recent high. So view it as an opportunity. Nothing has broken other than public sentiment. And I argue that the drop you saw then in 1980, for example, yes, that was top of the old range. Silver just gone from like what, $5 to 50. And it had a four-fold move in the last 5 months of that explosion. I'm talking 2 quarters roughly. In 2010 and 11, it was a 7-month explosion, which doubled in half the price of silver in 7 months. Both of those surge events, still caught in that old range though, were triggered by the spread breakout of silver versus gold, where you could plot the relative performance chart and you could draw a line with a crayon and say, if you get above that line, you're breaking out over a multi-year base. And when it did, it had a tantrum. We did the same thing, except even a bigger and clearer base, silver relative to gold, at the close of November. So it's only 2 months and 2 weeks now into a likely couple quarter surge.
Well, that's, as always, Michael, this has been an interesting discussion. I want to thank you very much for spending time with us today. And I guess your message that you really want to convey to investors is that get long gold and get long silver.
And they're miners. My preference right now, personal investments are, I favor silver over gold vastly, despite the recent drop. And I favor the gold and silver miners over gold as well. They have not broken out yet versus gold. They have firmed nicely over the last couple of years. The miners have beat gold, but they've been still stuck in a range of performance readings that they've been in for 11 years at very, very low valuation levels. They're challenging the upper end of that range. If they break out, you're going to get a gusher in the miners. And I suspect we're going to see it this year.
Well, Michael, that was a great discussion. And if someone would like to learn more about you and about your services, where can they go?
It's Oliver MSA for momentumstructuralanalysis.com, olivermsa.com.
And I will make sure I have a link below in the show notes.
Thanks, James.
Michael, once again, thank you and good luck in the markets. So when Pascua-Lama is up and running at full production, you said they're going to produce 40 million ounces of silver?
Their original production plan had about 40 million ounces of silver per year and about 700,000 ounces of gold per year. And so it is truly a world-class gold mine with a really, really healthy silver credit. That's the original production plan. They are refreshing it to have a look at it. It's the mill, the first line is 90% built, the second line is 40% built. So we're hopeful that they get at least part way there. But there is an incredible endowment of silver at Pascua-Lama, no doubt about it.
I'm sorry, you will get how much of that 40 million?
25%.
25%.
So we'll see close to 10 million ounces of silver a year.
So you're currently one of the largest silver producers?
Yeah, we're 5th largest in the world. Our
20
guidance
million
for
ounces?
2025 was 20 to 22 million ounces. As you can tell by our first 3 quarters, and of course I'm privy to our 4th quarter, it's a good year. It's been a good year. We are currently the 5th largest silver producer in the world. Something like Pascua coming on, the bulk of our optionality in terms of projects that we have in our portfolio that aren't part of our current production schedule is in silver. It's Pascua-Lama, which is, under its original plan, 9 million ounces a year and 9 to 10 million ounces a year. And Navidad, which is another 2 to 2.5 million ounces of silver a year. So if those 2 projects come into play, we will be one of the largest silver producers in the world.
I would
Might have to change our name back to Silver Wheaton.
I would love to see the price of silver if and when Pascua-Lama comes online.
Well, the trend line is definitely positive for silver. The fundamentals behind silver are so much stronger. And the other factor that doesn't come into play and isn't out there is the fact that here we are in the business trying to finance silver production and we can't find it. So, I don't think what doesn't get recognized enough in discussions about silver is that the supply side is drying up. Most silver comes from lead zinc mines. Nobody's building new lead zinc mines in this world. And the existing lead zinc mines are getting very tired and very old. And there's not enough of a share in revenue in the silver side. Definitely at $80 an ounce or $75 an ounce, it's starting to get, have more contribution, but it's not enough to drive expansions and exploration in the lead zinc space. We need higher prices in lead zinc. And that's the only time that we're going to see an increase in silver production. There's definitely a lot of silver companies out there, but silver mining companies only contribute about 20 to 30% of worldwide silver production. The bulk of silver comes from byproduct production from base metal mines.
And what price do you think we have to see in lead and zinc in order to stimulate production or mine building?
Well, I mean, there's no black or white answer there, right? It's a phase thing. Any strength in those prices will help support in terms of moving forward. But I'm going to tell you, the biggest challenge anywhere in the world, the problem with lead zinc mines is the bulk, any significant production, is substantive big open pit mining operations. The challenge of, first off, finding them, second off, permitting them, second off, the capital cost behind them. You look at copper projects, again, big scale base metal projects, the capital cost is $10 billion plus on a lot of these assets. Those are very, very strong. So it's not so much about, what price, it's how much strength do you see in terms of demand for lead and zinc. And that's the big challenge that I think there is in that space. And so there's always going to be weakness in the supply side on silver because of that lead zinc deficit in terms of opportunities.
And the move we saw in silver in 2025, it was up 140%, but it seemed to accelerate as the year went on. Do you think the market's catching up or waking up to the fact that there is a massive deficit?
So I think silver was trading as a industrial commodity up until about the middle of last year. And I think what's happened around the middle of last year is that there's been a bit of an awakening about precious metals from the retail and from the institutional side. You're starting to see more and more take up there. Now, silver has always had strong support in the American market, in the United States. Silver is the affordable precious metal. It's treated like that. And so when the retail market truly fully wakes up in the United States, that's where silver really shines. Now, keep in mind, traditionally, silver has always traded at about a 30 to 40 ratio. And when I go back over my career, close to 40 years now, the first 30 years, that's where silver traded. For the last while, it underperformed gold dramatically, and it climbed up to the point where it was about a 100 to 1 ratio. We're now down to 57. There's still a lot of legs behind silver in terms of just getting back to our normal trading relationship with gold in a market where you've got retail interest in precious metals. And so I still think there's strength. It wouldn't surprise me at all to see silver over $100 by the end of 2026.
And Randy, just because we're on the topic of risk, you've done a lot of deals over the years, some good, some bad. And before we talk about the good ones, why don't we first talk about the bad ones, because I think there's a lot to learn from them.
Again, in the history of Silver Wheaton and Wheaton, I would probably point to Pascua as being the one where I would say that's almost the biggest, the most lessons learned. And I think the challenges in life is always taking mistakes and turning them into lessons so you don't make those mistakes again, right? And so, the lessons we learned in Pascua were the biggest. We've had other assets that have gone bankrupt. We did very well through our protection, right? We've had our security in place, so we got a share of the proceeds when the asset went through bankruptcy. We've had assets change hands, change ownerships. We've renegotiated. The one thing I'll say that differentiates, again, a streaming company from the traditional royalty companies that our peers all are, is that we really do focus on the health of our partners. And that's how you minimize risk, is that we watch how our partners are doing. We visit every site at least annually, at least once a year. We talk to our partners, we watch their performance. If there's issues, if our partners aren't healthy, we're not healthy. And so we need to find a way. And so I'm going to be proud of the fact that more than half of our contracts have been adjusted one way or the other to unlock additional value, to create. We're not a charity, we don't give anything away, but we make changes to try and incentivize and improve and optimize so that we create more value on a continual basis. And we're also not scared to collapse a stream or sell a stream or vend it back into the operator itself. We've done numerous, probably 6 or 7 of them. We really put a lot of focus on managing our portfolio. It's not like the royalty company that just buys it and sticks it on the shelf and hopes and prays that they win the lottery and get a prize on that huge shelf of lottery tickets. We have a much smaller but much more focused portfolio that we manage and stay on top of to ensure that our partners are healthy. And we put a lot of effort into making sure that our partners stay healthy, and that in itself minimizes risk. And that's the best solution.
Pierre Lassonde quite often speaks about Gold Strike, how he and Seymour Schulich acquired that asset for $2 million back in the early 80s. Now it's produced over $1 billion in cash flow. Do you have a similar success story?
Oh, we have a lot of success stories. That's I've listened to the Gold Strike story numerous times, described as the lottery ticket. I always like to say that at Wheaton, we don't invest into lottery tickets. We invest into ounces, not acreage. We're building into again a small managed portfolio that is optimized. But the closest example I would say to that is the Zinkgruvan mine in Sweden. Right after we created this company back in 2004, we actually announced it in October and had shares started trading right away again in I think it was October 20th of 2004, and within a week we had a reach out from Lucas Lundin, now passed, bless his soul, but a good friend of mine. I'd known him for a long time, but he reached out and said, "Hey, I just bought this mine off of Rio Tinto in Sweden called Zinkgruvan, and it's a lead zinc mine, but it's got some silver production. I'd like to do a stream, whatever that thing is that you just did down in Mexico. I'd like to, monetize my silver production, and be able to use that capital to go forward." And so I flew out to Sweden, beautiful country, love Sweden. Flew out and had a look at the mine, and ultimately we gave him $75 million to acquire 100% of their silver production for $4 an ounce. That's what our production payment was. It was $3.90 an ounce plus a 1% inflation kicker. So I think right now we're paying about $4.50 an ounce from that mine. That mine produces somewhere between 1.8 to 2 million ounces of silver a year. It had about 8 years of reserves in front of it at the time. Lucas, the beauty of this story is Lucas had bought the entire asset for $125 million. We didn't have $75 million in cash, and so I gave him $50 million in cash and $25 million in stock in Silver Wheaton, and he had a hold on that stock. He couldn't trade it for 6 months, but in that 6-month period, Silver Wheaton's $25 million stock tripled in value. It actually more than tripled. It was quad in value. So he ultimately got the mine for free, so to speak. The silver stream that he did with us ultimately paid him more than enough back, and he got the mine for free. But let's fast forward to today. This mine now has, I think last time I looked, 14 years of reserves in front of it, so it's more reserves than it's ever had. It's been operating now for about 180 years continuously. A long, long operating history in Sweden, one of the most stable, good, strong jurisdictions. It was just taken over by Boliden. Lundin sold it to Boliden. It produces about 2 million ounces of silver a year. Silver is $75 an ounce, so let's call that $150 million in value to us per year. You got to knock off the $4.50. So now it's $140 million a year. We only paid 75 for it, and it's still got 12 years of reserves in front of it and wide open exploration potential. We've got a lot of stories like that in our company, and so it's normal for investing into the space.
So if you were to add up all those cash flows over the years?
Oh, well over $1 billion.
A $75 million investment has created over $1 billion.
Well, and in terms of future value, even more, right? And so, it's been, we've got a lot of stories like that.
Now, you became CEO in 2011. At that time, the market cap of Wheaton, or I guess it was Silver Wheaton,
right,
was $10 billion, and now it's well over $50 billion. Did you envision that type of growth in market cap?
Yeah, I don't tend to look at market cap because market cap is a result. My focus is on the production itself. It's on, okay, how do we unlock, how do we expand in? And as you said, we were focused on silver at the time. I've always had, because I came from the operating background and in the gold space, getting to 1 million ounce a year production is always sort of a hurdle that kind of says that you've made it in terms of a mid-tier to senior gold company, right? And so my objective at the time when I came on was to try and get the company to 1 million gold equivalent ounces a year. And I looked around at the silver space with my team, and we realized that it was impossible to do it in the silver space. There were just not enough opportunities in the silver space for us to actually get to that level of gold equivalent production. And so we knew right then we had to go into the broader precious metals. So a strong shift to gold immediately. Slobo deal, the first phase of Slobo deal in 13, another one 15, another one 16. Constancia, a whole bunch of other gold streams and all that. In 2024, 65% of our revenue came from gold. And so we definitely have grown into the gold space. We've added some silver production, but definitely most of our growth has been in the gold space. Happy to report that we're on a path to 1 million gold equivalent ounces. Our guidance that we came out with at the start of last year, early 2025, had us getting to 1 million gold equivalent ounces by 2031. happy again to report that with these higher prices, what we've seen is a whole bunch of our partners dramatically accelerate growth. They're all pushing forward expansions and dramatically up in production levels. And on top of that, we've made a few new acquisitions over the course of the year. The big ones being, of course, the Hemlo transaction that we helped support there. And so that's immediate production that we're adding to our portfolio. Spring Valley that we added in, and some other stuff. And so, it looks to me like we'll probably hit 1 million gold equivalent ounces by 2029 now, which is an incredible growth profile. This year, our guidance was 600 to 670,000 gold equivalent ounces. We're definitely at the top end of that guidance. Our first 3 quarters had us pointing towards the top end of that guidance, and so and we just got about a 50 to 60% growth profile over the next 4 years. That's what I'm most excited about in terms of that commitment to try and get to that level, and the fact that we are on a clear path towards that. And that doesn't count any new acquisitions. And I can tell you, the balance sheet is incredibly strong. There will be more acquisitions. Streaming is a very competitive, very attractive source of capital for everyone to build mines.
Well, listen, Randy, thank you very much for spending time with us today and sharing the Wheaton story. I do appreciate it.
Always appreciate it, Jimmy. Thank you.
Did you know that 80% of our viewers are not subscribers to our channel? So be sure to subscribe to our channel, Bloor Street Capital, and also hit that thumbs up button and leave a comment below. Thank you for your support. Michael, thank you very much for joining us today. You head up the Silver Institute, and for those who aren't familiar with this organization, maybe you can tell us a little bit about it.
Sure. So the organization was founded in 1971. At the time, it was primarily just an information resource for those that were involved in the market. At the time, photography was the leading end user of silver, and we put out reports on coinage and photography and so forth. And then it developed over a series of years into a market development association. And, we have a little over 30 members. We represent a little over 80% of global silver mine production from the mining side. We have refiners, we have end users, we have those that sell silver and buy silver. So it's a very wide range of market participants that are involved in the Institute. And really, our mission is simple. We want to put on programs that hopefully at the end of the day will chew up more silver through the demand sector. And we put out information on the market. So, just this year, we'll put out 2 or 3 market trend reports, which are concise, shorter reports on specific components of the market. This year, we're going to look at the gold-silver ratio. We're going to look at silver movements from country to country, since we faced several issues last year from time to time with respect to getting silver to locations that needed to have the silver. And we put out our World Silver Survey, which of course is considered by many to be the leading document on silver. And we'll put that out this April on the 15th.
And as you mentioned, the World Silver Report, the new edition is coming out in April, but if investors want to access 2025, they can do so on your website free of charge.
Yeah, they can actually go to our website. We have a whole library of every World Silver Survey that we've put out since 1990 can be downloaded at no cost from our website. On the 15th of this year, we'll post the 2026 edition, and we will also send that out to our subscribers and those that follow the Institute.
So let's move on, and I want to get your thoughts on the silver price that we've seen in the past year. It's up over 200% in the past year. It's up 40% year to date, which is just remarkable, these numbers. And I want to compare it to the price of gold. Gold's up about 100% in the past year. It's only up 16% year to date. How do you explain this move in silver? What are your thoughts?
Well, look at this market is really firing on all cylinders. You're looking at issues across the globe, geographically, political instability. There's dollar debasement. You're seeing a flight to hard assets, and silver is leading the charge. People are concerned about a potential frothy U.S. stock market, and this is all leading to investment in silver and gold. Look at the silver price per when you look at it versus the gold price. Silver is an easier metal to access from a price point perspective. But most people, or many people who do get into the silver game, they do it because they see the long range potential when they're looking at both industrial demand and the store of value that silver has historically provided investors over the years.
And so I want to play devil's advocate here because you just went through a number of reasons why it's moving. But of course, gold's had a big move here in the last 2+ years. And I understand why people buy gold. I mean, central banks, they've taken their buying from 18 to 20% up to 25 to 30% here in the last 3 to 4 years. And of course, it's also used as a reserve currency, as a hedge against inflation and also monetary debasement. Silver, on the other hand, is not used by central banks. And I'm kind of wondering with this move that we've seen, especially just here in the last few weeks, do you think silver's become more of a meme stock? And I bring that up because I remember when we spoke in 2021, 2022, there was a report in the Silver Survey that spoke to the Reddit effect.
Yeah, I don't think it's trading as a meme stock by any means. At least we haven't seen that activity on social media. What we have seen is this, James. We're seeing robust institutional demand for silver. We're seeing even more robust individual retail level demand for silver. And just talking to people in these markets in the United States, in China, and in India, the demand is off the charts for silver coins and silver bars. People are lining up in China to access silver. People are lining up in India to access and purchase silver. And in the United States, we had a rough couple of years at the retail level, but it's picking up quite strongly. In just talking to these dealers across the country, it's hard to get your hands on metal. The refineries in the United States are running 24/7. There just aren't a lot of refineries to produce, to refine the silver. We have a new one coming online in a few years in Tennessee from Korea Zinc. It's going to be a zinc silver smelter, and we just need more of those. And when you couple that with the fact that mine production has been rather stagnant over the last few years, and we're only calling for a small increase in 2026, you can see where there are shortages from time to time, and supply gets very, very thin while the demand gets very high. And we are now in our 6th year of a structural market deficit, and that's been going on for the last 5. Now this year, we're projecting another deficit in the market. So supply is not equaling demand, and you're seeing people, for a whole host of reasons, go into hard assets and precious metals like gold and silver.
Right, and I'm glad you brought that up because I just want to throw out a few numbers here to add some more context, but annual silver production is around 1 billion ounces, but yet demand is around 1.2 billion ounces. So as you mentioned, we have this deficit going on for 5+ years, and I believe the deficit is probably approaching 1 billion ounces now. But like we mentioned, this has been going on for the last 5 years. Are people just waking up to this now, that there's this massive deficit, and is that also contributing to this massive move?
This is really, I don't want to use the word slow burn, but it has been. Okay, we started off 2025 at $29 and change, and look where we ended the year. Okay, we breached the $50 mark in October of 2025. And since then, it's grown another 50+%. So it took 40 years to get to 50. It took just several months to get over 100. And this is not done by accident. This is done by investors who are really looking at silver to sort of backstop their own portfolio, or they're just having a pure silver play at that.
And Michael, you mentioned India a couple of times, and in the 2025 Silver Survey, you mentioned that the growing popularity of silver ETPs in India has really increased or grown in the last few years, and they were first launched in 2022. Maybe you can just provide some more detail on that. And I guess the reason why I ask is because my interpretation was that in India they were always more bullish on gold, or they always would purchase gold and not silver.
Well, the interesting thing is even at these price points, the Indians continue to pour money into silver ETPs, digital silver products, as well as with gold. You said 2022, these are relatively new products on the market in India. It is taking away some market share from the retail side of the silver investment equation. But it's all positive news. I mean, look at last year, we had over 230 million ounces of silver globally go into all forms of ETPs. And India was a strong provider of that number. In other words, they like the access to the ETPs. They like owning silver through that mechanism. And what we've seen so far to date, it's going strong again in 2026. But globally, we're not hitting records of over 300 million ounces like we did during the COVID era, but we're not where we were in the, in 2025, 24, 23, where it was in some cases less than 100 million ounces a year globally going into ETPs.
So why don't we look at, we discussed many of the reasons why silver is going to go higher, or why it has gone higher here in the last few months, but why don't we look at some of the risks? And when you look out into the future, if there was one thing that really stood out in your mind as a big concern with regard to the silver price, what would it be?
Well, I think when you get to these levels of the silver price, you may have some investors who want to have a position, may think it's a little too high. But on the other side of that equation, you also have those with the FOMO, the fear of missing out. And we've heard a lot about that since the beginning of this year. And maybe that's one of the reasons why it took it to $117. Fact of the matter is that people are going into silver for several reasons that I've already outlined. The world is not a happy place right now, right? We're facing wars overseas. We're facing a potential conflict with the U.S. and Iran. The U.S. dollar up until today has been struggling, but traders have been getting out of the U.S. dollar. Central banks have been going to gold, like you mentioned earlier. They're not buying U.S. treasuries. They're not investing in the U.S. dollar. And that sends a very clarion signal call to investors globally. These trade issues that were first initiated when President Trump came into office in January of last year really have hampered to some degree other countries' impression of the United States. Gold is a leading benefactor of that through central bank buying. I wish silver was on the portfolio of these central banks. Maybe it will one day. We hear rumors that Russia is looking at adding silver to its official reserves. So far, there's been no evidence of it. Last year, Saudi Arabia, through one of their funds, got into the PSLV in Canada, but it wasn't the physical side. It was an ETP product. So there are risks in any investment. The fact of the matter is that silver has enjoyed a remarkable, let's just say 14 months. And quite frankly, it was a slow burn getting up there. But once it hit these levels, it just took off.
Yeah, it was almost like there was a lot of shorts in the marketplace, and the buyers chewed through those shorts, and then that just created like this massive wave of buying.
Oh, that's exactly right. And this wave has continued, and it will continue even after today. The interest, the investment interest in silver is really strong.
And in the past, recycling has been a significant source of silver. With these high silver prices, do you anticipate that might pick up in the coming year?
Well, that is always the case at these price levels. Even when it was $25 an ounce or $30 an ounce, you're going to see more silver being recycled into the market. Typically on the silver side, though, it's a result of gold. So people who are trading in their gold coins, mini gold bars, gold jewelry. We'll also sweep silver into the mix. And we are calling for a slight increase in recycling in 2026.
Michael, one of the interesting components about silver is that it's used both for industrial purposes but also investment purposes. Industrial represents approximately 60% of production. Maybe you can just speak to that and where you and your team think it's going here in the coming year.
Yeah, industrial demand for silver has been exceptionally strong over the last several years. In 2025, while we don't project it to be a record year as we saw in 2024, we do see it to be quite strong, and that's all being led by photovoltaics, which when you look back just 10, 15 years ago, it was a very minuscule component of overall industrial demand. But it's not just photovoltaic demand. You're seeing demand growing exponentially for automobiles, electric vehicles, hybrid vehicles, the infrastructure needed to charge those vehicles. As a vehicle becomes more complex with its electronic components, more silver goes into that car. And one of the things that we're really keeping an eye out on, and we did a report last December on silver, the next generation metal, is data centers and AI. The energy requirements to operate AI, they're being fueled by these data centers, which are popping up all over the world. I think we've had a 5,000+% increase in data centers in just 2 years globally, and they chew up a lot of silver. I don't have an exact number, but if you can extrapolate the electrical context, the electrical wiring, the electricity demand to run these data centers to power AI, it's quite extensive. So that's an exciting new demand sector for silver. Not to mention the fact that it's used in medical applications, Band-Aids, hospital rooms, surgical gloves, instruments. It continues to grow because even though that's a smaller amount of silver that's consumed, silver is really helping to save lives throughout the world.
And China is the world's largest producer of solar panels. They're also the third largest producer of silver. But I'm wondering if you've seen any indication that they might be buying silver aggressively, like stockpiling silver for solar panels. We've seen them do this before in the past with uranium and also lithium.
Yeah, we are seeing evidence of that. I mean, you're seeing the silver market in China. Well, first of all, it's very strong, right? They traded a higher premium versus the New York spot price. At one point this year, there was about a $14 or $15 disconnect in China. There was a lot of talk earlier this year about export restrictions from the Chinese government to other countries with respect to silver. All that really was at the end of the day is there were stronger licensing requirements. And if you look at 2026 versus 2025, there are actually two more additional authorized exporters of silver to the global market. It's a very important market to silver, as is India, as is the United States. And in China, you're seeing individuals lining up, queuing up to buy silver in all the major cities.
Well, Michael, this has been a great discussion. I want to thank you very much for spending time with us today. Before we wrap it up, I want to put you on the spot now. Where do you think silver is going to end up at the end of the year?
Well, we don't like to give price projections here, James, and I think I may have told you that in the past. But look, at all signs continue to point north for silver. The market is very strong from the demand side, from the investment side, and I think the market has a lot more room to run.
And in terms of research, you mentioned that the World Silver Survey is coming out in the month of April. Any other reports that investors should be aware of?
We'll have a report in March on the gold silver ratio. We get a lot of questions from people about what that number really means. There are investors who place a high premium on that number. It's a number that people don't totally understand why that number is. Sure, it's simple to say how many ounces of silver does it take to buy 1 ounce of gold, but it's much more complex than that. And So we have several other reports coming out through the year. And I should note that you can sign up at silverinstitute.org for all of our publications, which are free of charge. And we'll add you to our mailing list, and you'll get everything the day we break it.
And you and your team are always going on the road meeting with investors. Do you have any big marketing trips coming up that investors
Well,
should
I'm going to
aware
be
of?
in PDAC. I'll be at PDAC. We'll be speaking at PDAC alongside with our colleagues at the World Gold Council. We'll be going to India in April. We'll be going to the Singapore Bullion Market Association meeting in June. We'll also be going to the LBMA event in October in Italy. And of course, we will make our second appearance at the Dubai Precious Metals Conference later in the fall. So yeah, it's a big operation with respect to getting overseas to all these venues and events. But the fact of the matter is that silver needs to have a place at the table. For years, it was somewhat ignored. Now we're speaking at all these events. Now we're keynoting at many. The fact of the matter is the world has woken up to silver, and the market participants have recognized this, as have the individual investor and those that have an eye on silver.
Well, that's a great overview, and thank you very much for spending time with us today, and I hope to see you at PDAC.
I hope to see you too, James. We'll touch base beforehand. Thank you.
Thank you. Well, that concludes our virtual silver conference, and I hope you found it useful. If you did not get a chance to see all the presenters, you can check it out anytime on our YouTube channel, Bloor Street Capital. All presentations will have chapters, so you can easily go to a specific topic of interest and make efficient use of your time. Be sure to subscribe to our channel, Bloor Street Capital, and you can also follow us on Spotify and Apple Podcasts. Once again, thank you for your support and good luck in the markets.